So good morning, everybody, and welcome to today's master event. Thank you so much for attending. I really do appreciate you joining us from all over the country, as always. So we've got some brilliant sessions lined up for today. For those of you who haven't met me, my name is Paul Sylvester Evans. I'm obviously working for Apricity. And today we've got three fantastic companies who are coming in to speak to us. First of all, we've got Alex and Tom, who are going to be from Blackfinch, talking about negative screening and the impact it has on ESG. And as always, with all of our sessions, you have the ability to add questions in on the chat function. And also, we also encourage feedback at the end as well. And we're able to ask the guys any questions that we have after that. So that will take us up to about 10:40, where we'll have a Q&A before the break then. Then we've got Matt Yates from 7IM, who's going to be talking to us about alternatives. And then we've got the guys from Tilney Smith and Williamson talking about macro and crypto assets. Now, you'll see on the screen, we've got a very important poll. So I'd be very grateful if you could, first of all, give us your views on that, just so we know what we're dealing with today, and it can very much help us shape the sessions that we've got coming up. So if you please answer the poll, and then when we've done that, I'll get Jazz to show us and see if we're telling the truth or not. So we take a few seconds to do that. So very pleased to see you taking today seriously. 77% definitely not wearing pajamas, whether I believe that or not. That's not a problem. But as always, I mentioned about the interactive side of it. We really appreciate any questions as we go through. So please feel free to use the chat function. As you know, today's event is CPDable. And we'll come out to you after today's session, both to get feedback on all of the three sessions that you heard, but also to help us shape the master events moving forward. Today's event has been put on purely around feedback that we've had from yourselves, which we're very appreciative of. And enables us again to dictate what we're doing in the future. Although I'm sure, as you know, we have actually mapped out events pretty much for the rest of the year, and you're all very welcome to join. So I'm now going to hand over to Alex from Blackfinch, who's going to talk us through, as it says, the negative screening damaging for ESG. So over to you, Alex.
Cheers, thanks. Tom, do you want to kick off?
Yeah, thank you very much, Alex. If I'm honest, I'll kick off by saying I'm quite disappointed that only 8% of the audience are still in their PJs. I definitely won't be standing up to prove that I'm in that 8%. But thank you very much, everyone, for inviting us onto this session today. My name's Tom Jaffrey. I'm a business development manager here at Blackfinch, and I'm joined by Alex Sumner, who's one of our investment directors. And today, what we're going to talk about is who Blackfinch are. We're going to talk about our investment process, and really then we're going to focus on negative screening and whether or not that's damaging for the ESG agenda, in which Alex is going to talk us through our views on ESG and how we integrate ESG into our multi-asset proposition. Before I start off, we have got the boring slide to get through, but very much important. Everything that we cover today is for professional advisors only. It's not targeted for the end investor. Feel free to give that slide a good read if you're interested, to make sure that you're completely covered from a compliance point of view. Right. So to kick off, at the end of this session, what we'd love for you all to do is to be able to walk away and have a good understanding of who Blackfinch Asset Management are, what we stand for, what our portfolios are aiming to do. But our key learning objectives for this session are to describe the main approaches to ESG integration. And we believe there are two core ones, so positive screening and negative screening. We'd like you guys to be able to walk away and to understand and highlight what the main benefits and disadvantages of negative screening are. And that negative screening, which is possibly the most widely used process and concept within the ESG space. We'd like you to be able to explain and understand the concept of positive screening, which is an approach that we take within our portfolios. And then we'd like you to be able to explain how factors other than performance can help and can be affected by ESG integration. So they're your key learning objectives for the session. Before we go into the detail around ESG integration, negative screening and positive screening, I just want to introduce you to the Blackfinch Group. Some of you may have heard of us, some of you may not. So the Blackfinch Group is an independently owned asset management company, and we're a specialist multi-asset manager. And we have three core pillars to our business. So we've got our asset management business that Alex is one of the lead portfolio managers of, where we've got model portfolios and multi-asset funds. We have Blackfinch Investments, where we have IHT mitigating solutions, both listed on the alternative investment market, but also unlisted IHT propositions. And then we've got a ventures team, which offers EIS and VCT propositions. So we're one of the unique asset managers in the market space that offers tax incentivized investing and also asset management, multi-asset investing. We're independently owned by our CEO and CIO, and our business model is really driven and service led, and we're exclusively advisor facing. So we don't have internally any advisors that work under the Blackfinch banner. We service advisors across the UK, and we service them exclusively. We've got a strong track record across the three of our pillars, and our approach, especially in the asset management space, is differentiated, particularly in such a crowded market. I'm sure all of you are aware that the MPS and the multi-asset fund space is extremely crowded, and our approach and our ways of managing money are differentiated, which I think the next slide actually starts to bring this out. So our investment proposition, when we founded it almost 4 years ago, was created from a blank sheet of paper. So Alex and Gareth, who are the lead portfolio managers, created our proposition from that blank piece of paper, and it was designed to be distributed to the retail market across the UK. And what we wanted to do was to create a proposition that was relatable to end investors, relatable in the sense that they could understand what the benchmark for that proposition was, and relatable in terms of aligning our proposition to the common investment objectives of end investors. So what that meant is we did away with any industry benchmarks, such as the MSCI World or the PIMFA or IA sectors, and we created a proposition that targets to beat inflation, so the consumer price index, plus a predetermined amount net of all fees within our control. So as you can see there on the left-hand side, you've got the defensive mandate all the way up to the enhanced growth mandate and an income portfolio, all of which, apart from the income fund, all of which target to beat inflation plus a predetermined amount. Now, we've done this because we believe that it aligns very nicely with the common objectives of clients, which is to retain the purchasing power of their investments, to beat the bank rate, and also we believe that investment objective is understood by the end investors, and it's clear and quantifiable, and it's very clear as to whether we as an asset management manager are achieving our investment objectives. Our income fund doesn't target to beat inflation, but targets to yield a 3.5% annual distribution net of all fees. As you can see, our portfolios, just before you go back, Alex, our portfolios are risk rated by two of the leading risk rating providers, so Dynamic Planner and De Facto. We've got, in model portfolio form, we've got defensive, cautious, balanced growth and enhanced growth. And then we're looking to have that full complement of propositions in multi-asset format by the end of 2022. So at the moment, in multi-asset format, we've got the defensive, cautious, balanced, and an income fund. Thanks, Alex. So just to reiterate, and I know every multi-asset provider or product provider will focus on or talk about their key differentiators, but I really do want to hammer home our focus on client-centric investment objectives, because as a provider and as a multi-asset provider, we do think that across the market, a lot of investment objectives are woolly and are non-quantifiable, and that's something that we really wanted to change when we built our proposition. So that's why we have client-centric, clear, quantifiable investment objectives that aim to beat inflation plus that predetermined amount. everything that we do within Blackfinch and all of the communication that we deliver to advisors aims to have zero jargon, aims to have no complex financial language or industry benchmarks. That's super important for us because we know that the end investor, or the target clients, so to speak, often don't understand financial services lingo. And we understand that advisors need to rely on us to deliver investment commentary, market commentary, or presentations like this in a clear, succinct, jargon-free way to help them deliver the proposition to their clients. So that's something as a proposition is super important for us. We have a forward-thinking and logical approach to ESG, which Alex will cover a bit later on in the deck, but it's something that we feel passionately about, and it's been at the very forefront and at the center of our proposition from our foundations. And as a firm, we are looking to work with only a select number of firms across the UK to ensure that our service-led proposition is maintained and that we can deliver a really strong client-centric service proposition to advisor firms. And I think the last point that I'll add is we're flexible and dynamic based on our size, and what that means is that we can launch propositions, we can launch products in consultation with advisors, and our income fund is a great example of that. We listened to advisors, we heard that there was demand for a natural yielding income solution in the multi-asset space, so we banged our heads together and we created that proposition and brought it to the market. And I think that's an example of how we can work with advisors such as yourselves to bring solutions to the market if there is demand. With that, I think I'd like to introduce Alex, who's one of our lead portfolio managers at Blackfinch. He's been at the company for a number of years now and was essentially one of the founding fathers of that proposition. And he's going to cover and go into much more detail how we integrate ESG and also our views on negative screening. So over to you, Alex.
Thanks very much, Tom, and thank you for having us here this morning, and thanks for your attendance as well. It's most appreciated. I just want to start by sympathising with how ESG fatigue is setting in to large parts of the industry, and I always kind of think about, you know, if your inboxes are anything like my inboxes, they're rammed full of ESG related topics, subject matters, ESG fund launches, and you know, it really is I think fair to say that, as we've said on the left hand side here, ESG focus has massively increased since 2020. I always look at 2020 as kind of the year of ESG, the kind of boom in ESG. Now, we look at that as a good and a bad thing. So this explosion in ESG, positive and both negative. It's positive in the fact that it's raised awareness of the importance of the ESG factors. But I think on the negative side, this explosion in ESG has led to a degree of confusion, saturation, and fatigue in the market. You know, there's so many different terms and definitions around ESG approaches: sustainable, responsible, ethical, negative screening, positive screening. And of course, what this has done, certainly for the end clients, is really increased confusion. Over on the right-hand side of this slide, you can see as well, there is often just a focus on the E of ESG. So if I said to you ESG, automatically you might think of wind farms, you might think of electric vehicles. And of course, whilst those are very important parts of ESG, they are absolutely not the whole picture. They are not all of the factors that we analyse, and they are not going to be the sole focus of ESG. Final bullet point on here, though, what I do think is brilliant about ESG, particularly for financial advisors, is this is a fantastic subject to really engage clients, to really learn about, okay, let's try to understand not just what you want from your investments financially, but what kind of good do you want them to do? What's the added benefit to you being an investor, rather than just financial returns? There's a plethora of additional benefits to being an investor. And I'll give you a couple of real world examples that you can take away and use with clients today. Typical ESG integration methods, we don't need to labour the point here, but we've kind of got best in class on the left, impact investing in the middle, and negative screening on the right. Best in class investing really doesn't screen out entire sectors based on what they do. Best-in-class investing will look at potentially controversial sectors, and let's pick oil and gas as a real easy example. And oil and gas, you might say, okay, there are some companies in the oil and gas space that I do want to hold, but there are absolutely some that I do not want to hold. Impact investing in the middle, that puts financial returns second and has the primary objective of generating measurable social or environmental impacts. So I might offer you a portfolio if I was an impact investor that said this portfolio will produce 50% less CO2 emissions than the index, for example. Over on the right-hand side, negative screening. Negative screening in its most simple form is where I say, here's an investment portfolio, but I categorically will not hold any companies that do X, Y, and Z. So let's have a little bit of a deeper dive on negative screening. Negative screening really historically has been the method that's been in the industry for the longest, been around for decades, and it's actually got a little bit of a bad reputation because back in its early iterations, negative screening was typically much more expensive, and it did previously deliver inferior investment returns. That's absolutely not the case today. The industry has evolved much more, but it does still have that general kind of reputation about it. Point number two, I think negative screening is absolutely the most familiar ESG integration method amongst advisors and clients. Point number three, though, what I get excited about, what I find interesting as an investor is I think it's probably the most common approach to ESG. It's very simplistic, but, and this is what we're going to discuss today, is it perhaps a bit blunt? Is it a bit of a blunt instrument to integrate when we're looking at ESG? So let's look at common strategies that can be employed in negative screening. So no doubt you've had many fund managers since 2020 in particular pitch their ethical or ESG propositions to you, and hopefully some of these 5 will resonate. Point number 1, screening of entire sectors and industries. Very, very common. That would be me saying to you, here's an investment portfolio, but it's not going to have any oil and gas in it, and it's not going to have any, I don't know, alcohol production in it. Point number 2, you might have carbon aligned screening. That's where I would say to you, here is a portfolio, and it's aligned to, every company in it is aligned to the Paris Agreement, for example. So every company in your portfolio is working towards delivering on the Paris Agreement goals. Point number 3, very interesting one, third-party ESG scoring data. Those are your MSCIs, your Sustainalytics, your Morningstar Globe ratings. These are where we take third-party data and we build a portfolio based on the best scoring ESG companies based on those third parties. Number 4, screening based on revenue generation. That's where I might say to you, here's a portfolio, it has some alcohol in it, but I will ensure that any company in that portfolio generates no more than, I don't know, 5% of its revenue from the sale or production of alcohol. And then point number 5, screening against standards. So these just drill down into the 5 topics that we've just covered and why these approaches could be damaging. So let's look at these very high level first of all. Point number 1, screening of entire sectors based on just what they do. Could this lead to ESG regression? For example, oil and gas majors today, some of them, are reinvesting significant amounts of capital into renewable energy generation. I've got a good example of that for you later on. So are we missing out on an opportunity here? Question mark. Point number 2, carbon aligned screening focuses just on the E, and it's actually very backward looking. If I'm going to build you a portfolio based on my carbon emissions from companies, I only have data of what that company has previously produced. It takes no account into what the carbon production of that company will be going into the future. And as an investor, I invest looking forwards. I am investing for the future and what I believe the returns I can generate for your clients into the future. So question, should I be basing my future investment decisions based on historical data only? Question mark. Point number 3, ESG third-party scoring businesses. Now, something very interesting here. If you look at kind of MSCI and Sustainalytics, there was a study done and it was updated in 2020. And it looked at the correlation between the scores given by those 2 major ESG ratings agencies in the same company. And the correlation was at 0.54. That is not great. So what that is basically telling you is you can have one company, so say Amazon, and the correlation or the ESG scores, depending on what company you were, what rating agency you were using, sorry, would be very different. That is not particularly helpful for investors. Who do you believe? Who do you align with? I don't know who's right and wrong, by the way, so that makes a very difficult decision for me to select a company. Let me just really reiterate that 0.54% correlation. If I look at a bond and it's rated by S&P and Moody's, so again, two of the largest credit ratings agencies, the correlation between their ratings is 0.99. So that just gives you a feel for just how difficult it is for agencies to rate companies quantifiably on an ESG score versus it is on a credit rating. Point number 4, screening on revenue generation. You know, if I'm going to build you a portfolio and say that, look, I'm going to protect you from anything that sells alcohol, for example, I wouldn't be able to buy Sainsbury's. And again, I think, you know, because of course of their links to distributing alcohol, any supermarket for that matter, it's just I'm picking on Sainsbury's, but you know, you've really got to ask clients, if you don't want anything to do with a particular sector, how deep do you want to go into the value chain, if you like? And point number 5, I absolutely agree that negative screening against certain standards is vital. You know, negative screening against things like companies that violate international treaties, absolutely vital. You know, you do not want to be investing in companies which are completely ungoverned. They're total loose cannons. Of course, you need negative screens when you're an investor, when you're building a portfolio, to really get rid of some of those particularly controversial companies. That's especially relevant when investing in developing markets. You know, there really is material risk there of investing in companies which are particularly bad, harmful for social, environmental reasons. And again, you really want to be screening those out for obvious reasons. When is negative screening appropriate? Well, I used to build bespoke DFN portfolios. I was at a very traditional stockbroking firm, and every client had a bespoke portfolio, and they were perfect for clients with very particular ESG or ethical views. And I always use the example of a great client of mine, previous client. He had a strong objection to anything to do with fast food due to personal issues that he suffered in his family. Anything to do with fast food had to be screened out. So the ingredients, the production, anything to do with the kind of distribution of fast food, all had to be screened out. So every single stock had to be researched meticulously. But then again, he was happy to pay the higher fees with a bespoke portfolio, but he had a portfolio that was perfectly aligned to his views. And I absolutely maintain that belief today. You know, we don't offer bespoke portfolios at Blackfinch, but I fully and wholeheartedly support that for certain clients, you know, negative screening, absolutely appropriate, and bespoke portfolios, fantastic solution. So we ask advisors quite a lot, particularly since 2020, look, what are your clients telling you about ESG? What is the general feedback? And the left-hand box there is the most common response that we have had from advisors. They say, look, most of my clients want to generate a positive, strong, attractive financial return, but they also want to know that their money is not going towards activities that are materially damaging for the environment, for society, for that wider ESG agenda. So we're regularly told that, and you know, we really value that feedback from advisors. We always ask advisors as this kind of conversation, as this part of the industry develops, really important. So I would ask this: if clients want to generate a positive financial return whilst having a positive impact towards society and the environment, solely employing a negative screen potentially could be a counter to this. So we can have a little look at that a bit later on. So let's look at the potential impact on returns. This is kind of the legacy issues that negative screening has got. Negative screening, by its very nature, gives you a narrower investment universe to select investments from. Of course it does. Now, that can be a good thing, but also it can be a negative thing. Reducing the investment universe obviously reduces your potential to select and invest in future winners. But I think more importantly, what about the broader ESG outcomes? So if we ignore performance, and if you have a client that feels quite strongly about the more wider ESG outcomes, can negative screening actually reduce the impact that these clients can have in improving these ESG issues? So the danger of wholesale divestment, and this is just something that I think clients may not be aware of at the point of sale when they're selecting a negatively screened portfolio. If you have divested from a company or a sector, you as an investor have no say whatsoever over that corporate's behavior. because you don't own shares in that company, you don't own bonds issued by that company. So by that very nature, you obviously have no say over how that company is run, is governed, and the future direction of it. Persistent negative screening can lead to depressed share prices, and in extreme circumstances, share prices can get so depressed that private equity step in. Private capital take over, and therefore they're accountable to absolutely no one. So personally, my view is it is quite important to hold these potentially controversial companies in the public eye, in the public markets, so they remain accountable to public equity owners. ESG and net zero targets could be delayed or scrapped if the company is privatized. And actually, it's vital that a lot of these companies have access to capital markets to give them the cash they need to pivot. If these companies don't have access to capital markets, it's much more difficult or more cumbersome for them to raise finance to pivot into more sustainable business models looking forward. Let's have a look at a case study then. BP, I think oil and gas is obviously the most easy sector to pick on. It's obviously a very dirty industry. It's a heavily polluting industry, and it's got a terrible reputation historically. Quite rightly, by the way, I don't condone a lot of the historic behaviors and activities that have got on in this sector. But what people often overlook at is the green credentials that some of these oil majors have. BP, for example, just last year completed its major strategic entry into renewable energy with a partner called Equinor. Look them up, they're an enormous Norwegian renewable energy business. High level target here, BP is targeting 50 gigawatts of renewable energy capacity by 2030. 50 gigawatts, when I first sort of looked at that, I thought, well, that kind of doesn't really mean anything to me. To put that into context, that is twice the amount of wind energy, onshore and offshore, and the entire of the UK today. So BP alone, one company, is looking to do double the onshore and offshore wind production that the UK manages today. So that is big in just 8 years' time. When we look at a particular city, for example, they're looking to supply New York with 3.3 gigawatts of renewable energy alone. So again, that's enough to power more than 2 million homes of completely renewable energy. Now, point number 3 is particularly interesting. BP are not doing this out of the goodness of their heart. They are not doing this because they love the rainforests and they love the planet. They're doing this to make some serious money. They absolutely recognize the significant opportunity that is on the table here for pivoting into this space. They are doing it to make money, to grow the future value of their business. Me as investor, what do I want to look for into the future? I want a company that is going to grow. So of course, this, particularly to me, is a very interesting opportunity. And again, as you can see, final bullet point there, the investment that BP need to make is a minimum of 5 billion a year. That's actually tenfold. They're increasing that tenfold from current levels today. So 5 billion a year, that's a significant chunk of cash. They can certainly do more. But again, imagine if they didn't have access to capital markets, to public funds, to issuing bonds, etc. Much more difficult for them to actually raise the cash to do this. So as you're probably seeing now, if we just rely on negative screening, yes, at first glance, great, very simple, easy to explain way to integrate ESG, but it does reduce investor choice. So if I negatively screen oil and gas, for example, with that one very high level example, you wouldn't get access to that future investment potential. Also, I just wanted to highlight something else. Vodafone is an interesting one. So adult content, pornography, the distribution and production of is quite rightly a very often screened sector. And I think it's quite interesting, again, when we look at how deep you want to go, Vodafone as a telecommunications business, and again, this is not just Vodafone, I don't want to pick on them, this is any major telecoms business, generate up to 5% of their revenues from the distribution of pornography. The distribution of pornography through their 4 and 5G networks is absolutely contributing to Vodafone's annual revenue. But Vodafone or any telecoms business, again, I feel bad for picking on Vodafone, it's just that's the company I had the data on. They have a fundamental social responsibility as being a telecoms provider. You know, you imagine we had the lockdown in 2020 without mobile networks, without telecoms as it is today. You know, it would have been a very lonely and very different lockdown, not to mention the benefit, the impact, sorry, it would have had on businesses. You know, if we'd have had the lockdown 30 years ago, before Zoom, before 4G, before 5G. So Vodafone, any telecoms business, huge social benefits, but equally there is exposure to often screened sectors through adult content distribution of pornography. Final bullet point there as well, by the way, Vodafone actually been quite instrumental in helping developing nations accessing bank accounts. So I don't know if you know this, but in developing nations, they've kind of gone straight from having no bank account at all to having instant access bank accounts through mobile apps. They kind of missed that section in between that we had in the developed world with kind of your banks on the high street kind of thing, your very traditional banks. They kind of went from no banks straight to mobile banking. And again, Vodafone and other major telecoms business, big beneficiaries and helping that happen. So again, missing out on that if you employed a very strict screen on adult content. As you're probably picking up on, ESG is obviously very complex, multifaceted. It's not just about the environment. We're not going to go through all these points on this slide, you'll be relieved to know. But what I wanted to highlight here is, as an investor, when I'm looking at a potential and future investment opportunity, these are all the key headings under the E, S, and G banners to actually analyze and integrate. And it's really important to know that a lot of companies that, if you're adopting positive screening, will be quite poor scoring on a lot of these metrics. So there is room for improvement. But for me and my personal views here and how we run the money at Blackfinch is really about, let's look at these trends. Are they improving? Are they deteriorating? Or have they plateaued? You know, these are really what we want to get a hold of when we think about future investment returns from that company. Fact finds. Again, we talk to advisors, we say, are you bringing in ESG questioning into your fact find? And more often than not, many advisors are. They're quite keen to bring it in. They're quite keen to talk to clients about saying, okay, what are your ESG kind of, your ESG preferences? What's important to you, what isn't? Now, some standard template fact finds that we found online can be a little leading or a bit blunt. For example, do you want to invest in mining? Yes or no? You know, and again, you Google mining stories and you'll see some quite frankly horrendous stories of worker safety, the destruction of local villages, towns, populations, corruption in a lot of countries. Not good. So absolutely understand with a client why they would say, no, I don't want to invest in that, because I've seen on the news, you know, dams bursting and the destruction of local towns and villages. It's awful. However, what if that mining activity was vital to the green energy transition? You know, what if these mining companies were vital in extracting minerals and materials and metals that are vital to production of batteries used in electric vehicles? In fact, one of my favorite examples is Anglo-American. Anglo-American, as you probably all know, huge multinational miner, major producer of diamonds, copper, nickel, and iron ore. Until very recently, I think it was until last year, the company also had exposure to thermal coal, you know, an extremely damaging process when it comes to environmental impact. So again, that was only sort of got rid of last year. So very recently, still had thermal coal exposure, which is absolutely awful. And again, the company, unfortunately, has been at the center of major controversial environmental and human rights issues during its past. You know, quite frankly, shocking. So again, I fully understand why a lot of clients would say, no, I do not want to invest in Anglo-American. But what if I widen that story for you a bit? Anglo-American have actually recently partnered with a company called Umicore to transform and simplify the way hydrogen is stored and distributed. Why is that important? Well, think of hydrogen fuel cells in electric vehicles. One of the biggest headwinds to hydrogen fuel cells is, how do you transport and store it? That's why traditional battery electric vehicles using kind of mains chargers have taken off, because of course you can build a charging station, much easier to charge your car, don't need to store and transport highly volatile hydrogen. Why does this relate to Anglo-American? Well, they are developing a technology to fuse hydrogen to liquid. Fusing hydrogen to liquid basically means that we can use all of the infrastructure that we have across the world today to deliver that fuel. So instead of petrol and diesel coming out of the pumps at your local petrol station forecourt, it will be this liquid fueled hydrogen. So again, we don't need to be building and constructing all of these charging stations across the country. We have the infrastructure ready today. It is much cheaper and it is much more effective. And as I say, final bullet point on this slide, if this takes off, it will massively increase the speed of widespread adoption of green vehicles. So again, a huge bit of research and investment from Anglo-American, but you wouldn't get exposure to that if you screened out the mining sector and only looked at the historic issues of this company. Brushing ESG issues under the carpet, we really don't want to do that. If we identify an ESG issue with a company, we absolutely just don't want to brush that under the carpet and forget about it. Negative screening can be guilty of doing that. So negative screening, if you look at a company and you say, wow, there are quite a few issues in that business, but I'm just not going to hold it. Are you actually helping to solve the problems in that company as an investor? Are you using that capital to influence the corporate's behavior to brush up their act? Give you another example here, Pemex. This is an enormous Mexican petroleum company. This company was held in a couple of the funds that we hold within Blackfinch. It's Latin America's second largest enterprise by revenue, and it's also, according to an article I saw in The Guardian, the 7th most polluting company in the world. So clearly there are some significant ESG challenges with this business. The fund manager that held the assets with this company really put the pressure on Pemex to improve their ESG impact. They were engaging with this company over a number of years. They were a significant holder of Pemex debt, so they had a good chunk of sway over the behavior of Pemex. Now, over the years, they monitored their engagement process, and actually, it materially deteriorated. There was evidence that there was no safeguards put in place for staff and families when the coronavirus pandemic unfolded. There was a complete lack of willingness to manage the near and longer term climate-related risks. And the investment manager specifically requested a very important business plan by a certain deadline to allow the fund manager to assess whether or not this company was going to address the ESG concerns. They didn't even produce that business plan in time. So what you've got to ask yourself then is, this is actually, not only is it a terrible company in terms of ESG, it's also an awful investment prospect. Why on earth would I want to be holding a company that is not addressing any of these key issues and is blind to the shift in energy production that is going on around the world? What was the result in this case? Complete divestment, total divestment from the company, absolutely supported by us. We do not want companies like that in the portfolio. So if we just look at oil and gas industry as a whole, you can see very clearly now the difference between, say, a BP, for example, and a Pemex. They both sit in the same sector. They would both be negatively screened out in a negative screen portfolio, but arguably, I am more excited about the future investment prospects of the one company than I am of on what's going to generate investor returns and help protect capital. So I think my internet's going funny there. Are we back?
Yeah, you're back on now, thanks.
I think you're back, Alex, yeah.
Sorry, right, we're back. Okay, ESG transformers and improvers, as you've probably got by the gist of this now, I'm particularly excited about the prospect of transformers and improvers from an investment point of view. I wholeheartedly believe that identifying exciting transformers and improvers is a great way to make money, a brilliant investment return source, and it's hunting for these, which is obviously the main challenge. Positive screening is a great way to identify and uncover these opportunities. What is positive screening? Well, it's absolutely a forward-looking approach. It's very labor intensive. As you've seen by just that very basic oil and gas example, it's much more labor intensive to unearth those ESG transformers in a sector than it is to just screen out the whole sector. So it requires a great deal of additional research and time spent on analysing companies and funds that are buying such companies. And not only that, you have to do your ongoing monitoring. Ongoing monitoring and evaluation is vital because in the case of Pemex, for example, they may have made all the right noises 5 years ago, but you need to continually monitor them to ensure that the progress is being made. And like in the case of Pemex, you've got to identify where progress is deteriorating and then ultimately make a decision whether or not to divest. Great thing about positive screening as well, on the right-hand side, it helps support companies that are looking to pivot towards better ESG outcomes. So those companies that are really hungry for fresh capital to pivot their business models, you can, or your clients can particularly, be fundamental in providing that company with the capital they need to pivot. In my experience, that is quite a nice story to tell clients. You're saying to clients, look, your money is going towards helping companies get to their goals faster and more efficiently because people like you are investing in the right companies. And of course, final bullet point on this slide for me, most important and exciting bit, unearth hidden gems. So BP is obviously a very well-known company. That's why we're using it as an example in presentations like this. But there are many other companies which you will never have heard of before, which are on that transitionary pivot, very exciting future potential growth in their share price because of this market share that they're set to gain from pivoting their business models. If you wanted to catch up afterwards or at another time, do get in touch with Tom. I'm happy to give you some more examples. There's some great examples in the fast fashion industry, apparel manufacturing in emerging markets. And actually, I think I might have another one here. Yes, alcohol. Alcohol is another very often negatively screened sector. And a company that you may not have heard of before in the alcohol sector is Kweichow-Moutai, one of China's largest, in fact, at one time, I think it was China's largest listed company. It is a huge manufacturer of very fine, expensive Chinese liquor. This liquor is enjoyed in moderation. It is extremely expensive to buy a bottle of the Kweichow-Moutai. And of course, it is absolutely not contributing to the binge drinking culture. You know, this is not the sort of stuff that you swig on a park bench on a Saturday night. This is enjoyed in absolute moderation. It's brought out at political events. It's brought out at very important family events. So again, we're really talking on that very fine consumption in moderation. Now, why is it so expensive? Well, it's expensive because it's got a very unique taste. I'll leave you to be the judge of how it tastes. I've had mixed reviews, but its taste is all down to the purity of the water that's used in the manufacturing process. So the manufacturing process, the distillery sits on the bank of a major river in China, which I cannot pronounce the name of. You'll have to Google that. But the purity and the cleanliness of the water is vital. Kweichow-Moutai have invested billions of yuan installing water purification and filtration systems way upstream. Why? Well, because when the water passes that system and filters past the distillery, it's beautifully clean and clear. But that's had massive benefits for the environment. Think of the marine life. Think of the removal of plastic waste from the waterways. Think of the removal of toxic waste from the waterways that this distillery and this filtration system has benefited. Not to mention that, think of towns, villages and cities further downstream on the river that are also benefiting from the clear and filtered water as well. So alcohol, you would never immediately think, okay, that's going to have a massive environmental benefit. But this case, and actually Kweichow-Moutai is not alone. You know, if you look at AB InBev, you know, much more widely known Western alcohol producer, they say water is beer. You know, without decent water, they have no beer. You know, these alcohol companies are absolutely in tune to the sustainable usage, supply and treatment of water. So, you know, it really does connect the two there with the benefits that these companies can have, which is often overlooked if you just said, I don't want any alcohol. Just in the final few minutes before we wrap up then, ESG in our investment process, absolutely fundamental, but as you can probably see, and you might have picked up on, the main reason that we integrate ESG in the way we do is about financial returns for the future. You know, if we can really identify these companies that are pivoting, that are working towards these goals, that are investing significantly into the new economy, the new opportunities. As an investor, I just get really excited by that. So that's why it's point number one here. ESG as a key driver of performance. Just to reiterate, you know, I absolutely acknowledge and know that a lot of other clients will put investment returns second, and they certainly want to avoid particular areas. Absolutely fine. We are not the solution for them, by the way. We would not be suitable for clients like that. But it's just for us, investment driver, performance driver, very exciting. Point number two, winners and improvement. That's the winners and improvers, how we identify those winners and improvers, very key point. Number three, which I think is very interesting, particularly for advisors, is we are explicit on our approach and we're focused on transparency. Why is that important? Well, because of the explosion of ESG, particularly in 2020 and over the last couple of years, there is a real risk of accidental mis-selling to clients. Accidental in the fact that a client thought they might have a negatively screened portfolio, but they may end up with a Blackfinch positively screened portfolio. Now, in some cases, that might not be suitable for the client. And it might be because there's just such a deluge of information and unfortunately an increase in greenwashing that it's very difficult for advisors and clients to sometimes assess what solution are they actually getting. So as a product provider, it's our job to make your job easier. We provide you with a very explicit and clear manual and procedures guide on how we integrate ESG, what we do and what we don't do. So at the point of sale, the client can digest that and make a fully informed decision as to whether our approach to ESG aligns with their beliefs. Number 4, we're committed to engagement and integration. So all these engagement stories that we hear of from our fund managers, we publish those to your clients every month on our fact sheets. So every single month, your clients get a real world ESG engagement example of a stock that's held in a fund in their MPS or fund. So they can actually get a real feel 12 times a year over, is this the type of approach that resonates with my personal beliefs or not? Number 5, committed to the United Nations Global Compact. Absolutely, as I said before, of course, we negatively screen on certain grounds. Of course, we don't want any company doing anything in the portfolios. Absolutely, that would be very irresponsible. So we do have negative screens, but it's just they tend to be applied at a very prescribed level, not just at a blunt sector whole level. Obviously, as a firm, we're signatories of the PRI, and myself, my co-director and our senior analyst team, as well our CFA ESG qualified investment professionals. We are obviously committed to helping you on this ESG journey if you want to, if you want any additional support, if you want more stock examples, if you want more example questionnaires. You know, we've produced packs and literature to help advisors have these conversations with clients. As I said to you before, you know, we always ask advisors, look, are you starting to talk about ESG with clients? What's the client's feedback about it? Is it difficult to talk to them? Do they like it, etc.? So we build support packs for you to use as much or as little of as you like. In conversations with your clients. And again, as I said before, it can sometimes be that the client needs a different investment solution to one offered by Blackfinch. That's absolutely fine. What's important is that the client gets the solution that's right for them and they've got the knowledge they need to make that decision. So how am I doing for time? 17, we're good. Concluding thoughts. So just to wrap this up, top left, there are many approaches to ESG, as you've probably picked up on. Top right, though, none are wrong. I often think that a lot of asset managers, particularly since 2020, try to put forward the case that their approach is right and everyone else's is wrong. We're absolutely not like that here. I'm obviously deeply passionate and believe very strongly in positive screening, but I categorically do not think that any other approach to ESG is wrong. I absolutely don't believe that. I just believe it's such a emotive and subjective topic that different approaches will appeal to different clients. And I do feel quite strongly that a lot of asset managers are too woolly about what they, about how they approach and integrate ESG. Bottom left-hand side, look, our role as a product provider and as a supporter of IFA businesses, we need to help advisors be better equipped to have client conversations and complete due diligence around ESG with end clients. As I said at the start, this explosion of ESG in the industry has caused a lot of confusion, a lot of greenwashing, a lot of noise. You know, we really need to, as an industry, need to cut through all that and make sure that the client really understands the kind of main approaches here. Bottom right-hand box kind of ties into all that, and that ideally has the outcome of empowering and supporting advisors when it comes to ESG topics and conversations, and that's absolutely what we believe in. So I think that wraps it all up. Apologies, that was a bit of a information dump, but thank you very much for listening. Happy to take any questions, and yeah, back over to you, I think, Paul.
Brilliant. So thank you very much indeed, Alex. It's absolutely superb stuff, and really interesting. And I have a few questions, but also I'm going to invite, if anyone has any questions that they'd like me to ask Alex and Tom over the next sort of 10, 15 minutes, if you could put that into the chat function, that'd be brilliant. But the first question is, so you mentioned right at the beginning that your target returns are linked to CPI.
Yes.
So I'm just really interested, first of all, to get a view on inflation at the moment. And also I see that so I mentioned that there's a fund coming out, an Enhanced Growth Fund, which is launched this year, which has got a target of CPI plus 5%. So are you concerned kind of with that potential target return? And also, what are your views around sort of the shortish and medium term situation regarding inflation?
Yeah, very good point. And actually, you know, when I was sort of designing the proposition 4 years ago, did I think that we'd see US inflation at 7.5%? No, I did not. However, I do believe that the inflation target returns now are more relevant than ever, especially with clients who are particularly, I am told from conversations with advisors, clients are more and more concerned about inflation now. You know, it really is appearing on the 6 o'clock news, and it's quite rightly a concerning topic for clients. My view on short-term inflation, you know, we're monitoring a lot of the data points that would support the fact that inflation is still transitory, but just sticking around a lot longer than anyone initially expected. I think if you look at a lot of the inflationary pressures we've got in the global economy today, they are things like constrained supply chain as a knock-on effect from the COVID-19 pandemic, you know, so shipping ports are operating at half capacity, backed up ships that cannot deliver their goods because of these snarled up supply chains. We've got factories that are operating on partial staff because, again, you're getting pinged, you're getting staff off ill. So, of course, you can't produce the products you need to satisfy the demand. Couple that with things like increased consumer demand, all the cash that people built up through lockdown needing to be spent. So you've got this explosion in demand coupled with supply chain constraints. And of course, those two do not look very pretty. You also have labour problems. You know, we saw it ourselves in the UK with the shortage of HGV drivers when it came to delivering fuel. And we all know what that did to the petrol forecourts around the country for a few days. All of this really is the economy, the global economy, just trying to figure itself out, trying to wake itself up from the sleep that it's been in for the last couple of years. And again, do I see those as permanent long-term factors? No, I absolutely don't. I'm seeing the oil price soaring. I'm seeing the gas price soaring because, again, demand is really picking up here. And we've got tensions in Russia and Ukraine, which are not helping energy prices. Again, do I see these as long-term? No, I don't. Do I see, and in fact, getting back to the data points we're monitoring, spending demand is falling rapidly. All the cash that people have built up through lockdown, you know, people have built their extension, people have bought their hot tub, people have bought their new car, if you can get hold of one. People have, you know, booked their exotic holiday because they're fed up of being in home for the last couple of years. So actually, if you look at the spending data, there's a real sharp decline in that kind of surge in spending that we saw, because again, this excess cash buildup seems to have been spent. So again, that supports that more sort of sanguine inflation outlook, you know. And again, we're sort of seeing, fingers crossed and touching wood here, the outcome of the Omicron variant of COVID-19 being less severe than previous variants. Again, that will help people like factory workers returning to work full time, factories operating at capacity, shipping ports opening up again, you know, allowing that free flow of goods. I'm not mentioning the Brexit word here. I do believe that is isolated to the UK, and there are challenges there. I do think the HGV problem around fuel was an issue there, especially. But you know, so my short-term views on inflation are it's going to be very uncomfortable for the rest of this year, definitely. But there are a lot of signs that point towards the inflationary pressures falling away. I think it'll peak in Q2 this year, and we should start to see signs that it really does drop off towards Q3 and Q4 of 22. Of course, I could be wrong, but what am I looking for in the portfolios? I'm looking for a lot of assets with pricing power. I'm looking for those investments that have direct inflation linkage to the cash flow, and I'm looking for growth investments that can pass inflationary pressures through to the consumer. So take an Amazon, for example, that's just hiked the cost of its Amazon Prime membership. That's an exact example of an Amazon taking those inflationary cost pressures, passing it through to the consumer. Take a Netflix, which is increasing the cost of the monthly subscription of Netflix by £1 or £2. The consumer don't really notice, they don't really care. It's not going to stop them subscribing to Netflix, but they're passing that inflationary pressure through. You know, these are really interesting areas for me, particularly when you see how those stocks have sold off recently because of inflation. I find it very interesting that these stocks are selling off because of inflationary pressures when they actually have the perfect ability to pass them through to customers. So That's what we're looking for. Yes, you are absolutely right. CPI plus 5% in the enhanced growth is its target. That's over any rolling 5-year period. And do I see those factors improving over the coming 5 years? Yes, I do. So I have every confidence in the portfolio investment objective.
And Paul, I think what I'd add to that is the investment objectives that we've got, which are the CPI plus 1 up to CPI plus 5, and the risk profile to each of the portfolios are the only 2 factors that really constrain Alex and his team. They have the ability to operate globally across asset class, sector, active, passive, in order to build a portfolio that is designed to achieve that objective over a 5-year rolling period. So they have the absolute flexibility to reposition the portfolios, take advantage of opportunities, reduce risk, or switch out into certain positions, as you know, Alex said, that have got that inflation linkage or that have got growth prospects that you can pass through inflationary pressures through, as opposed to a portfolio that, say, the risk rated 5 has to be 50% equities, 50% bond. We don't have any of those constraints. The only constraint is the investment objective and the risk profile, which I think is fundamental, and it's by design to help us achieve that investment objectives in environments such as this.
Yeah, that's great. No, thank you very much. You didn't know. I mean, yeah, absolutely. When you talked about that earlier on, the flexibility it gives you guys is superb, and it's just really interesting to hear your views on inflation as well, because through speaking to advisors both on the webinar today, but also on a daily basis, you know, it's coming up, as you say, you listen to the news, you hear about fuel and energy and NI going up and cost of living standards, etc., etc. So I think it's just really important to be able to go back to clients with information that we just came up with there, which is brilliant. So thank you.
Yeah, actually, just very quickly, your point about increased cost of living, you know, that will further squeeze consumer demand. And again, that really, again, is sort of actually people won't perhaps then buy that next big purchase. They won't perhaps book that second fancy holiday because, of course, all our bills are going up quite horrifically. And you know, supermarkets, your fuel, and again, that also plays into that deflationary or lower inflationary outlook, which of course the markets don't like. I absolutely get that. That's what we've seen so far this year. You know, a big bit of nervousness coming into markets because of that. But again, it also plays through into that medium long-term inflation outlook that we have.
Brilliant. Thank you very much. So that leads quite nicely to my next question, which is around sort of advisor support. So I really like what you said at the beginning around how you've been working with advisors when you've been shaping the funds that you have. And one of the things that we get asked quite a lot at Pericity is around ESG questionnaires. And you gave a great example around mining of having something which is maybe, if you think about the old closed and open questions, so getting a certain response by asking a question, but then using a questionnaire which would maybe broaden the response. So in terms of the advisor support packs, do you have things like the questionnaires and things which could support the advisors on the webinar today? And what do you like to see from advisors in terms of the kind of approach they take with questionnaires?
Shall I take the second bit, Tom, and you can take the support back bit?
Yeah, sure.
Yeah, cool. So on what we like to see from advisors, you know, we're very much about, we bespoke the service, not the portfolios. So in my previous role, I was a bespoke investment manager where every client got a slightly different portfolio, as I said. Here at Blackfinch, we have our flagship range of portfolios, which everybody gets, but the service is bespoke. So we bespoke the service, not the portfolio. And again, to your question, Paul, what do we like to see from advisors? It's more about what we can give them. So some advisors might say, look, here's a questionnaire that my compliance provider gave, or I found from a risk profiling agency, whatever that might be. What do we think? We say, here's a template that we've got. You know, you can pick and choose as many questions as you like out of that, but it, as you say, Paul, opens up that conversation a bit more. That I think clients might say, how strongly do you agree to this statement? And it might be about that mining example, you know, for one. And clients say, actually, I really agree with that. Or they might say, I don't care what they're going to do in the future. I hate what they've done in the past, which again, absolutely fine, but it will lead to that broader conversation that advisors can have with clients. But yeah, Tom, did you want to pick up on the pack?
Yeah, of course. So we've built a pack that is aimed and designed to support the advisor community. But what we're very conscious of is, you know, advisors, each and every advisor, all of you on the call today probably have different ways, different techniques and styles of asking questions to clients, those broad open questions to really understand what their goals and objectives are with their investments. So what we've done is to create an advisor pack that's really designed to act as a template to help you ask open questions around ESG. We've put together one-page template which could be sent out to a client prior to the meeting to say that you're looking to talk about ESG and what their views are on ESG. So when you get to the meeting, clients have already been thinking about it, are already warm to the fact that you might be asking about their views on ESG. And then we've put together a suitability template pack that covers all kind of different scenarios, from new money to switches from non-ESG to ESG from different providers. And apart from that, or in addition to that, you can just ask us the question. So I'm working on a number of cases at the moment with clients that have got, they've got end investors that are looking to allocate capital, and they're looking for some sound bites, some examples, and also just some general support to help with the client conversations around ESG. So how we align to the UN Global Compact, a bit of wording around that, what examples we've got in the portfolio, that we can really hammer home the message around positive screening. We can all do that on demand. And in addition to that, we've also got a full ESG policy, both at a group level. So Blackfinch Group has an ESG policy. And then we've got Blackfinch Asset Management as one of those three pillars, has its own independent ESG policy, that how ESG is integrated into the investment decision-making process that we can share. And it's also a great source of information that can be drip-fed into clients to say how Blackfinch incorporates ESG at a group level and also at an asset management level.
Brilliant. Yeah, that's absolutely brilliant. I mean, again, linked to that, probably the final point is just you mentioned when you've sought feedback from clients that what their clients are saying is that for a positive return, but through a positive impact, which is absolutely what I hear as well in terms of when I'm observing client meetings, just the conversations through advice. So I think the examples you gave regarding BP, Anglo American, and Pemex, if you think about from the other side, it's really interesting as well. Particularly what you said, the examples of practices that they've ignored during COVID times, which has had that impact on the investment as well. Superb. Yeah,
I mean, for clients that are looking to generate a return, which is probably every single client you've got, clients are looking to generate a return, but they want to understand and know how ESG is integrated within their portfolios in a transparent way. That's exactly where we're positioning ourselves.
Brilliant. I don't know if you've seen on the screen in the chat, but someone's just asked about how they would be able to get one of these packs from you guys.
I can send it out, no problem. Perhaps I can send a pack out to everyone on this call.
Paul, if you could circulate Tom's contact details as part of the wrap up, then anyone's more than welcome to get in touch.
Absolutely. Yeah. I think there'll be real big demand for the material you guys have gone through, because it's been absolutely superb today. So thank you very much indeed for that. Just very interestingly, I was just looking up how much a bottle of that Mood Thai was when you were doing.
Oh yes, yeah.
So £160 for 200 ml, so it's about £40 a double. So
that's it.
It has been mooted within the Blackfinch team that one Christmas party we're all going to have a shot of Mood Thai, but
so doing your bit in the environment, which is what we like as well.
I mean, so the Asian fund manager that lives and works out in China quite a lot. He's saying that the taste of it to the Western palate is questionable, is what I would say. I've never tried it myself, but there's a Chinese restaurant in just outside Birmingham that does sell it, so I'm quite tempted to just try a bit. But yeah, it's quite an interesting one.
That's good. That's brilliant, and another great example as well. So I think that's it for today. But just a huge thank you from myself. That was a brilliant session, and as I said at the beginning, we're very happy to take any questions after the event as well, and we'll come through to you, and we will definitely circulate, give you the information and get sure that the packs go out, because I think there's some brilliant stuff in there. So a big thank you from myself, gents, for your time this morning. Much appreciated.
Thank you for having us.
Great stuff.
Thank you.
So we're gonna take a break now. So if we could come back at 10:50, that'd be brilliant. Where Matt Yates will be talking about alternatives from 7 AM. So thank you very much indeed, everyone.
We're right in saying that questions at the end, Paul, is that right? And you're going to adjudicate it and keep an eye out.
Absolutely. So that's great time, actually. So welcome back, everybody. And thank you very much indeed for remaining on today. I hope you found the last session useful. I thought it was absolutely superb, as I'm sure the next session will be as well. But certainly what I take from it is things which are very relevant to what you can use with your clients, and very much in line with the questions which you ask us here at Apricity, which I see from our dealings with your clients as well. So I'd like to hand over to 7 AM now, who are waiting patiently. So Gents, over to you.
Thank you very much for that intro, Paul. We'll just fire up the slides seamlessly from my glamorous assistant that's operating the laptop and the wings. There we go. Does that look good?
Yeah, it's great.
Perfect. So that's today's date, the 16th of February, and I am Matthew Yates. So I'm the Deputy CIO here at 7IM. And the focus of today's presentation is really about the use of alternatives, or maybe just more broadly than that, alternative ways of thinking about multi-asset portfolios in the world we found ourselves in today. And in many ways, that is one of lower returns going forward. And we're going to talk about, what lower really means in a few minutes' time. What makes this easier for me is actually that many of these themes, many of these stories, much of what I'm going to talk about today is something that we've been talking about for the last 2-3 years. But it's extremely timely given what's happening in the last 2-3 months, I think. And so it's not just a timeless presentation, I think, but it's especially relevant to the world today. So without further ado, what are we going to go into? So there's going to be several steps to what we're talking about. We're going to talk a little bit about the backdrop for multi-asset portfolios. I said lower returns a second ago. I'm going to talk about what that really means, try and qualify that statement. Then I'm going to talk about how we can try to tweak multi-asset portfolios and traditional ways that we combine portfolios together to deal with that environment. I'm going to deep dive on a couple of positions specifically, or areas of investment portfolios specifically that we think we can help, and then we're going to try and bring it all together. I'll probably try and speak for around 40 minutes or so, and then that leaves lots of time for questions. And if history is anything to go by, who knows, I may overrun by 40 minutes because I just get so caught up in the moment. But there we go. So, like any good compliance presentation, there's CPDable to jump through the hoops. There's some learning outcome statements. Take a look at those, let them sink in. I'm not going to just rote read through them. And with that, let's head into something. So let's start with a poll. And I think, I started off by saying what's that we're in a lower return environment, but I'm interested in what people think that really means. So on this slide here, let's start with our first poll. So, what do people think is the guideline return for a balanced multi-asset fund? Balance means so many things to different people, but assume, 50 to 60% equity content, that's the IA, 20 to 60 sector. What do people think is the expected return? Let's call it, net of fees for a balanced multi-asset fund through time, and that's as we stand today. So that's not historically, that's looking forward from where we are today. There we go. So we've got a range. Nobody said 2%. The bulk of things are on 4%. So 67% of people said 4%, and 33% of people said 6%. That's interesting context, and I think it's probably not surprising, like exactly where the centre of that bell fits, and it actually probably aligns with our own thoughts. So on this next slide, what I've got are the ways that we can or try and cut that expected return journey through time. So based on our own forward-looking estimates, taking up the bottom-up asset classes returns, and for around the end of last year, our forward-looking return for a portfolio was around 4.1%. Which compares to a slightly higher return back in 2020, 4.5%, and a slightly higher return than that back in 2019 of 5%. Now, I suppose one interesting question is, why has that been coming down? Well, another way to view that is based on the chart on the right-hand side there, and this is, potentially the most complicated chart that I'll use today, but hopefully the relationship and what it's trying to say is clear. So what we've got on the y-axis is the return expectation. So that's the forward-looking return expected for a portfolio. And what we've got on the x-axis is the long-run volatility assumption. So each of those individual blobs there technical term for that, and on a chart, represents an asset class. So it could be UK equities, it could be global government bonds, it could be commodities, etc. And what you can see is how that's changed at different points in time. So orange current is at the end of last year, and blue is as of I think it was 2-3 years ago. So showing the journey that you've got on the bar chart, or the table rather, on the left hand side. Now, what does this show us? It shows that there's a positive return to risk, i.e. that as risk increases, return expectations increase, probably not surprising to people. But essentially that relationship that you can see on the left-hand side there, that returns are becoming down for portfolios, is almost like a parallel shift across lots of different asset classes. Now, one of the things that we find when we're speaking to advisors and when we're trying to communicate this story to clients is that sometimes this can be seen as a difficult message to say, difficult message to tell about, what forward-looking guideline returns for asset classes look like. Why would clients want to go into something that's got a lower return than it's had in the past? Well, I think the reason for that, and one of the reasons I think this is a good story, is on this next chart, which is almost one of my favorite charts for explaining, definitely top 3 charts for explaining why investment portfolios are so important in the environment we find ourselves in today. So here, each of the purple bars there, pinky purple bars, this is showing the amount of income you could generate from just sticking £100,000 in a bank account. So you've got a client, you've got £100,000, what return are you going to get for just putting it in the bank account? And back in, the mid-90s, the 2000s, you can see 4 to 5%, 6% maybe in some years, and £6,000 a year, purely just from bank interest. What I've compared that to in the light green bars is the income needed to beat inflation. And what you can see is that inflation for the last decade or so has been stubbornly higher than those level of interest rates that is available on bank deposits. Now, why is this important? Even if that purple line, through the Bank of England action is ticking up as we know at the moment, the lag is such that this is the real alternative for end clients. End clients may look at multi-asset investment portfolio returns that have come down, 4.5%, wherever it may be, and they may say that's unattractive. Well, their genuine opportunity cost, their alternative, is even less attractive. The returns available from simply sticking money in the bank is going backwards at a faster rate. And this, this element of the return spectrum is really what's been driving things. So I think when people talk about lower expected returns than they've had in the past from investment portfolios, that's actually a good message for advisors, because the returns available from the bank account are even lower than that, especially when we consider inflation and a slightly higher inflationary regime we find ourselves in. And another way to see that is on this chart here, which shows the UK gilt yield over the last 5 years. So essentially how much money you earn from lending money to the UK government for 5 years, and it's going back, like 25 years, over the last 25, 30 years. That's basically what the gilt yield is. How much do you lock in from lending money to the UK government? And regardless of the tick up you can see very lately in the chart, frankly, it's just lower than it's been historically. And this is important because this element of portfolios especially is the one that is, almost the low risk returns for portfolios. Multi-asset portfolios historically blend equities and bonds. And bonds, like government bonds, used to earn a yield for lending to the UK government, and that is no longer the case. This isn't maybe a new story to people. People have been calling the reversion in that line for a long time and heralding kind of the dangers of owning bonds. But not only did 2020 serve as a reminder and the COVID sell-off that potentially bonds are a risky investment, now more than ever in the last 2-3 months we've seen equal evidence of that. Got a chart that's going to show what that means later. But if you look back in history, so if you look back over, say, 2013 was another period. It's called the Taper Tantrum in the US. You essentially had the Fed start to talk about moving up interest rates, and that sent the equity market down and the bond market down at the same time. You saw that an element of that last year, and you're seeing this year an element of that as well. Bond markets and equity markets selling off at the same time. By some measures, depending on what bond index you own, some government bond indices are down 3 to 5% year to date, at the same time as equities are down globally a similar amount. I always like thinking about it in terms of almost the perfect Foresight portfolio. Let's go back to 2020, and let's say you knew exactly what was about to happen. You knew exactly that there was going to be a significant market drawdown, and that everybody was going to be sent home, and that monetary policy was going to be pumped into the system at an unprecedented rate. What would you probably do? You'd probably go, if you were allocating an investment portfolio, and you think that, okay, global government bonds probably aren't a bad call. If you did that with that perfect foresight, over the following year, you would have lost money. And this year, you would have lost even more. So, what am I really crafting this picture of here? It's a picture and a story that I've been telling for the last 2-3 years. One of the most dangerous things to say in finance is this time it's different. But I think you can certainly say that over the last 2-3 years, you are seeing signs that this time it is different. But bonds and the ability to diversify equity market drawdowns have fallen significantly versus the past. 2020 is evidence of that, and the last 2-3 months are evidence of that. And we think, as an investment house, that thinking differently about that problem is so important, and it's something we've been doing for many years. And this is where you get into this story about, is the 60-40 portfolio dead? It's the whole, context, that backdrop I've just talked about there of essentially how investors can deal with it. And so this idea of 60-40 being dead, the 60-40 portfolio, 60% equities, 40% bonds, offering a good return for investor was, really rests on the promise that bonds are going to be diversifying and that they're going to earn you a return. And we think that portfolios can do slightly better than that. And we think there's several different ways that portfolios and investors can think about positioning their portfolios to do better than that. What I've got on this next slide is the way that we can think about, what investors do. And people will have different names for this stuff, right? You can go to one house and they might call these things different things. But I put it to people that even if they have slightly different names for what they're doing in investment portfolios, these 3 categories, and I've highlighted investment selection because that's going to be the focus when I'm talking about alternatives. These 3 categories of what investors can do tend to make up, you can cover probably 90% plus of investment decisions that are taken globally under these 3 headline headers. So what are they? Let's define some terms. So strategic asset allocation, that's essentially just your long-term starting. You can think of it as your benchmark portfolio. Let's say you have an investor and you've got a risk rating model and you say you've got to deliver 8% volatility through time. Strategic asset allocation is basically just the mix of assets you use to achieve that. And that could be really simple. It could be 50-50, government bonds, 50% global equities. But most people will tend to have something more, complicated than that. Might have more asset classes, might have a more defined mix. Now, strategic asset allocation, the hints in the name, tends to be something that you just think you can hold and almost forget for 10 to 15 years. But on top of that, over the short term, tactical asset allocation is another area that people may kind of use or lever that people may pull in investment portfolios to essentially tilt things on a more shorter term basis. So that the equity market sells off. Do I want to add risk or add risk in certain areas? And frequent when people talk about tactical asset allocation, it tends to get very hung up on, just purely just trying to time equity market tops and equity market bottoms. That is really difficult to do. But when we think about it, it also extends to just thinking about themes that may be more interesting to take in portfolios. So what I'm going to focus on is not, how you can time an equity market bottom, because if anybody on the call knows how to do that with 100% accuracy, let me know. You can come and work in the team. But what I'm going to talk about are some specific thematic ideas that we really like at the moment, that we think, especially in bond space, make a lot of sense. So, we talked about government bonds being unattractive. We think there are some bond fixed income asset classes out there that can be attractive. And finally, investment selection. Are there specific investments out there that are, that can provide a role in portfolios? And alternatives are one area of investment selection that we've spent a lot of time on. As well as being the deputy CIO, I really head up a lot of our research in the alternative space. And so that's going to be the focus of the next few slides, because, you know, when people talk about low bond yields, alternatives are frequently banded around, but the definitions of what alternatives are is often, you know, so varied as to be relatively meaningless. So before we head into that, we've got our second poll, and what we really wanted to ask is, you know, for the people on the call, what's the main role for alternative assets in portfolios? Is it about generating returns? Is it about risk management, diversification, or is it about both? This is potentially one of those questions where there isn't really a right answer, but it's just interesting to get the context of what people think. Just framing it like a politician, so whatever you say, you can dig yourself out of the whole X post. Okay, give it a couple more seconds and then we'll pull up the results. There we go. So 26% risk management, 74% both, and interestingly, 0% in return generation, which I think, like I said, there wasn't a correct answer here, but, you know, philosophically, that's very, very close to where we're coming from when we think about alternative asset classes. I actually think it tends to go in cycles. You know, you see it persistently. What I saw back in 2019 was this big trend towards alternative assets being probably a bit more about return generation. You know, people's memories tend to be short, and the longer you've gone without a drawdown and without the need for, you know, diversification, risk management, the more people get tempted into higher risk things that are basically just taking equity risk in a different way. Private equity, real estate are really good examples of that. And certainly they weren't providing diversification through COVID. But yeah, most people said both. And I think that definitely aligns with the way that we think about things as well. We want to be diversifying. We probably want to do the sort of things that bonds used to do. You know, bonds historically have provided a negative correlation to at least a big equity market moves. But they also have had that base level of return. You know, if you just want to hedge your portfolio, you could just go and buy insurance on the portfolio. You want to probably do a bit better than that. So you want to generate a bit of return and have a bit of diversification characteristics in there at the same time, which is a really interesting way to think about it, because when you consider what some people, you know, think about when they come to alternatives, you get some of the stuff that's on this slide here. And I would argue that a lot of the things that are here tend to get more to that return generation point rather than they do risk management. You know, what have we got here? We've got some commodities, got wine. I always say that I would absolutely love my job to just be selecting the fine wine portfolio for 7am, but you know, we think a bit more broadly than that. And certainly, you know, some areas like cryptocurrencies are also a good example of, you know, alternative is such a broad definition. Frequently, it's like the other stuff that you can buy, and so you end up with this long tail of things that can include cryptocurrency, which I think most people on the call would probably struggle to argue is there for diversification and risk management properties. It's more there to try and generate a return. Some of the ones in the middle, though, are a bit more interesting. So, you know, the house there, that's what my marketing team thought property would look like. So, you know, property is an alternative asset class that comes up a lot. Now, why is property an interesting one to think about? When you're saying diversification, when you're saying risk management, it's always worth saying to what? Now, the core of most multi-asset portfolios is always going to have equities. And why equities? Well, equities are just generating almost this capital appreciation and paying back to shareholders through dividends through time. But theoretically, why do equities make money? It's quite an interesting question, but I think it's one of the ones that people don't ask enough. Equities, shares, stocks and shares make money essentially because the world grows. There is GDP growth in the world because you have population growth, you have technological developments, etc. As the world grows, the companies that operate in each of those countries where you're seeing growth have the ability to grow their earnings. And then what companies do is grow profits and pay those profits back to shareholders through dividends or share buybacks. And so at its core, the driver of equity returns isn't, you know, multiples have something of an impact over the short term, okay, but the core driver that persistently means that equities are going to generate returns through time is essentially growth, is global growth, GDP growth. Now, if you're looking for diversification in portfolios, it's always worth asking yourself, does GDP growth or just general economic growth drive the returns of these asset classes too? Because if it does, you're probably going to find that they're not that diversifying. Property is a great example. Demand for property and the ability for people to, pay back rents on property is clearly very linked to economic growth. The higher growth, the higher demand there's going to be for property, and the greater ability to pay it back to shareholders, to those that are renting out. Ditto commodities. People often talk about, let's leave gold aside as a bit of a special case, but let's think about oil. Commodity. If you look at commodity benchmark, energy commodities, oil, gas are going to be a reasonably large part of those commodity benchmarks. Why should oil be diversifying to equity market drawdowns? Yes, there may be some equity market drawdowns where, of some size where oil might be diversifying. But think about the really big economic shocks, those like COVID, those like 2008. Those tend to be accompanied by big economic slowdowns. And if you've got big economic slowdowns, there's going to be less demand for those input commodities. And so what I've really talked about there is why assets may or may not be diversifying, not through the lens of, look, quantitatively, have they historically been negatively correlated with assets, but say, why do assets generate returns? And if they're generating returns based on those same economic forces, chances are they're not a genuine alternative. They're just taking equity risk in a different way. And sorry to hear it, but you're probably going to be paying more for it to access these, expensive to access private equity investments, real estate investments. You're probably going to pay up in liquidity terms as well. And that, when we're defining terms, I wanted to spend a bit of time in that before we dive into some examples, thinking about what we really mean, what characteristics we're looking for. And yes, there's some return generation that's part of it, but there should be risk management. And really that means alternatives should be a genuinely different source of returns to those you're getting in the rest of your portfolio, and not just taking equity risk in a different way, or not just taking duration risk in a different way. Because otherwise there's, probably single digit basis points ETF you could, go and use that are very liquid to get access to those returns in a cheaper format. And so if that's what we're not looking for, what do we think? What's the checklist when we're looking at alternatives? And it tends to be those things here. There tends to be transparency into what's going on. There tends to be liquid, accessible markets, and they're performing a specific task. And that's important. We're performing a specific task on looking to be diversifying to the rest of our portfolio. And so for us, what we focus on are market neutral strategies that can benefit from both rising and falling markets. We're going to talk about some examples of what they mean, but it's fair to say that market neutral strategies tend to have a pretty bad name, because there's a few pretty high profile examples historically that have underperformed essentially. And I put it to people that the reason they've often underperformed is because they've often got too big, so they haven't necessarily had that high liquidity, or they've been a black box to those that are investing in them. And so for us, a key element of what we're doing when we're picking market neutral strategies is looking a level down and trying to find the, what's essentially going on under the tin. And some of those we build ourselves, some of those we pair with some outside parties to do, but they're always going to be liquid and they're always going to be transparent on cost. One example here on transparency, we have a strategy that invests in FX markets. On a daily basis into our risk systems, we're pulling in every single position that we own in our alternative portfolio. This isn't to say, oh, look what we're doing. This is meant to be a high-level theoretical discussion, but it's a reminder of the importance. Too frequently, when people invest in alternatives, they're often investing in black box. And for us, that doesn't cut it. It's so important to have that transparency, that look through to the underlying. So from that very generic, what we're looking for is essentially to replace the sort of properties that government bonds used to avoid. And that essentially is some return generation and some diversification. And so we're most closely aligned with most of the people on the poll. We're looking for both. And another really important thing to say is when I think about going from a portfolio to just equities and bonds, you'll see the alternative box there is, actually 4 or 5 different boxes. And what that's there to emphasize is that we do not believe there is a single panacea alternative asset that you can go and buy that's going to cover you for market scenarios. And again, another issue I think that people have had in the past is that they're overly concentrated in just one style of manager. These managers are, at the end of the day, or these strategies that we're developing, have a risk associated with them. They could always underperform. So you do need to be diversified among your diversifiers and alternatives. But just, that's theoretically what we're looking for. Let's go into some examples, but let's just say that that basket that we've developed internally has been, very successful over the last 2-3 years. You can see that global government bonds have had 2 very specific difficult periods over the last couple of years, specifically when bond yields have been as low as they are. One was actually in March 2020, when bonds and equities were falling at the same time. And another difficult period has been the very recent one. You've had this rising inflationary concerns in the market that's, taken the shine off some of the tech stocks, etc. So government bonds have been selling off again at the same time as equity markets. You can see in both of those situations, our investment portfolio of alternatives has been able to deliver. So for us, this is essentially like a carve out of what sits in our own multi-asset portfolios. This is just to say there that staying true to these principles, looking for those specific objectives of being return generating and defensive, not just focusing too much on things that are taking equity risk in a different way, staying focused on liquidity and staying focused on cost has delivered over the last 2-3 years. And it's a material part of our portfolios today. So that's the theory, which I think is important to give some context. Let's look at an example of what we mean by alternatives, because it's kind of like, oh great, so what are you actually investing in? The example I've got, and this is my marketing team's best estimates of what a deal looks like. So the strategy I'm going to talk about today is actually focused on an area of the markets. It's mergers and acquisitions essentially. And as a financial planning profession, we're probably all too aware of all the mergers and acquisitions that are going on all across our industry at the moment, but also, across the globe, frankly, there has been a wave of merger and acquisition activity in the last few years. And that's frankly been because GDP growth has been quite high and money's been very cheap. And mergers and acquisitions are a constant of financial markets. So a constant of not just a financial market, just of capitalism, really. It's a way essentially for corporate financiers to generate value, and that can be shown no better than that chart I've got on the bottom there, which shows that actually last year there was more M&A activity than we've seen almost for several decades. Now that in and of itself isn't necessarily like really danger, like warning signs. Like I said, it's actually in very many ways a rational financial decision to make at the moment, given how cheap money is and given just the level of growth that's out there. But what our strategy that invests in mergers and acquisitions does is tries to generate returns from mergers and acquisition deals. And it does so in the following way. So this is going to kind of get a bit theoretical again, but hopefully in stylized way, I can explain exactly how a mergers and acquisition strategy works. Okay, a mergers and acquisition kind of portfolio performance could work something like the following. So what happens, a share is traded. I'm going to completely make up an example now. Let's say Facebook, now Meta, is going to buy Twitter. So let's assume for a second that this orange squiggly line here is Twitter's share price. Okay, on the x-axis you've got time, and on the y-axis you've got Twitter's share price. So let's say Twitter's share price starts in this bottom left-hand side around $40 to $50 per share. So Twitter is bumbling along at $40 to $50 a share. Meta, Facebook, announces where that first purple circle is, that it's going to buy Twitter shares for $100 a share. It's going to buy Twitter out and it's worth $100 a share, so they're going to pay $100 a share. What happens when those mergers get announced in the market is that Twitter share price skyrockets. Overnight it will close to double. But it's not that rational that it would go through $100. Right, because $100 is the price when that deal is finalized. All they've announced is that they intend to buy Twitter for $100, and there will be that classic line that will be like, subject to regulatory approval, blah, 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 blah. Right, okay? So what that basically means is when that deal gets announced to the market, it's not 100% going to happen. And $100 a share would be the fair price if that was 100% going to happen. So what will frequently happen is that the price, rather than going to $100 a share, would go to something like $90 a share or $95 a share the day after that deal's been announced. And this literally is, in a pretty stylized way, just a carve out of, if you just follow all the shares undergoing merger announcements, this is almost exactly what happens. The price will rally on the day of the announcement, but it won't go all the way to $100 a share. Now, what that then means is that from the time that that deal has been announced and there's been that initial pop in share price to the time when the deal closes, which may be like 2-3 months later when all the legals have been completed, on the day that the legals are completed, the share price will be $100 a share because that's what all the shareholders will receive for that. Now, what mergers and acquisition strategies do essentially, it's called merger arbitrage among some, is invest in markets in a way, or invest in these companies in a way that all they're isolating is that spread there. So their only risk is that that deal doesn't happen. Now, the risks to that happening or not are clearly very different to the broader ups and downs of the equity market. You know, if deals are of strategic importance, whether or not the equity market is up or down doesn't tend to matter that much over the long run. Actually, COVID is a really, really good example of that. Because think of all there were lots of deals that were public before COVID happened. You saw 30-40% crash in the share price of companies globally through COVID. But a few months later, those deals were happening anyway. Essentially because, you know, if something's of strategic importance, it's of strategic importance. And so isolating that return is almost like providing merger insurance. That insurance is going to pay out that $5-10 a share that's left between that announcement price and the deal price, solely based on whether these mergers and acquisitions take place. And so you're generating a return that is solely related to mergers and acquisitions taking place rather than just the broader market. And if you look at the returns of assets, we use BlackRock, we partner with BlackRock for the strategy of this type, and you look at the returns of it over the last 2 years when we've held it, you can see that it's generated a return. It's generated a return that isn't, you know, strongly in double digits, but it's, you know, 5, 6, 7% a year. Essentially the sort of yields you used to get on global government bonds, but the ups and downs of that strategy are somewhat unrelated to broader equity market ups and downs. This drawdown that you can see around August 2020 was actually just related to a few high-profile mergers falling apart. The equity market didn't really crash around that period. You know, year to date, for example, that strategy is up, whereas broader equity markets are down. And so this is a good example of a return stream that we're generating from insurance in the mergers and acquisitions market that is fundamentally unrelated, that is generating its return based on a different risk factor to broader equities. Now, why I also like showing you this chart here is because there is some volatility in it. It's not just a bottom left, a top right 45-degree line that looks like a Ponzi scheme. There is volatility in those underlying strategies. What we try to do is blend those different strategies together to get something that's over time has this steady drift up, but can deliver greater returns when equity markets fall. That's exactly what we're looking to achieve. But it's not a zero volatility strategy, and people shouldn't expect it to be. And I think sometimes with alternatives, that can be how people set the mindset up wrong. You know, risk managed and diversifying doesn't mean zero risk, because eventually at the end of the day, you're looking for that both. You're looking to generate a return. So having talked about those more kind of specific alternative opportunities, what I wanted to talk about now is an example of a tactical asset allocation idea. So when I talked earlier, I said, you know, how we can generate returns, not just through timing equity markets up and down, which is, you know, tends to be very hard, but it's through maybe some alternative ways to think about traditional bond asset classes. I'm going to give you a couple of examples. It's kind of on this next slide here. Right, so the two examples of areas of the bond market that we quite like at the moment are in bank debt and mortgages. Now, those two things together sound absolutely terrifying. You know, if you pick things that were at the epicenter of the 2008 financial crisis, bank debt and RMBS or mortgages are probably the places you don't want to be. But we actually think they're really, really interesting opportunities at the moment. And they've been a stalwart, they've been a big part of our portfolios for the last couple of years specifically. Let's talk about bank debt for a second. So we all work in the financial industry, so I'm sure we're all aware of, you know, regulation, etc. no more has there been regulation felt more strongly than in big banks. You know, banks are less racy institutions than they used to be. In many ways, they're almost utility-like in their current format. Banks have almost been regulated out of existence. But what they have become in that world, because they've been so stable, is actually quite interesting credit opportunities, because you still get a pickup in the credit that you get for lending to banks than the broader market, even for the same credit rating. And the whole reasons for that is partly to do with this perceived complexity. But actually, we think, and it's been our view for some time, that if anywhere there's an area of the markets that is more utility-like, that is actually a good credit to own, banks are one of them. And actually, a great case study for that is 2020, is COVID. You know, rather than banks being part of the problem, you saw a recession where banks were actually part of the solution. You know, suddenly banks were being asked to turn on lending to creditors, and they could do it overnight because the riskiness of their broader activities, the proprietary trading desks of old, had largely gone. They were that much better capitalized. And that to us reiterates that view that we held before this period, that banks were actually a good area of the market to lend to, where you can get a tick up in yield. Not just that, but most people will probably be aware that as interest rates tick up, it's actually banks that tend to benefit from that. Because banks, interest rates going up means they can make a bigger spread essentially between what they're lending out at and what they're receiving from people that are loaning money from them. So they're actually a part of the credit market where higher interest rates, which seems to be the trend at the moment, they benefit. So for us, that's a good idea. But it's something that people, we think, often overlook because there's this perceived complexity. Another area is mortgages. So residential mortgage-backed securities specifically. Anyone that's seen the film The Big Short will get a much better description of this than I can. And if you haven't, I suggest you do. But there's long story short, there's somebody in a bath explaining it, but there's something to look forward to this weekend. But what are mortgage-backed securities? Well, it's just essentially a way to invest in packages of mortgages. And the specific part of the mortgage market that we like are what are called legacy mortgages. So they're essentially mortgages that were issued before the financial crisis. So they're kind of 15 years old. Now, many people will know one of the big problems of the financial crisis, especially in the US, was that you can just walk away from your mortgage in the US. And what happens then is that you have all these foreclosures. You know, you've got this loan against it, people just walk away from those and not paying it, and you end up with all these deserted condos and houses everywhere. But why are those actually good credits today? They were clearly very bad credits back in 2008. People were very highly levered into those properties. Why are they much more interesting today? Well, essentially, it's because you've had 15 years since that date worth of house price appreciation. You've had, because there were mortgages issued 15, 20 years, you've had 15 years worth of people paying down those mortgages. I'll put it to you that the people that have been paying their mortgage for 15, 20 years are pretty unlikely to walk away from their house, certainly compared to those that have only been paying in for 1 year. And not only that, but if you look globally, and especially in the US, and you look about the nature of the recession that we've just been through, if there's one strong point of the economy, it absolutely has to be the consumer, the US consumer. You know, monetary policy in the US was literally airdropping money into people's bank accounts. So if you're going to lend your money to anywhere, do you want to lend to, let's say in the broader corporate credit market, you see all these stories of increased leverage, companies loaning out money or without necessarily plans of what to do with it? Or do you want to lend to something that's improved in creditworthiness over the last 15, 20 years, i.e. the consumer, who've been paying equity into that mortgage, either there's more security against the debt, or do you just want to lend to a highly leveraged corporate? We prefer the former, as you can probably guess, but that's two examples really of things that are still optically bonds. They're still fixed income asset classes, but we don't think they appear in enough portfolios, probably because there's a perceived complexity. But when we break down the investment rationale, we think they have definitely a clear place in portfolios. Just bringing it all together now, I'll just skip over that slide. So, you know, we talked about really focusing on tactical opportunities and selection. You know, in strategic asset allocation terms, we tend to have more in EM and tend to have more in credit, kind of more generally. But what we really wanted to deep dive on today were what could be perceived, you know, alternative type ideas. So we talked about what we like and what we look for specifically in alternative strategies. we've broadened it out a little bit from just the diversifiers to say, what are some alternative parts of the credit market that we like too? And when we bring that together, what we have actually is a portfolio that is blending not just traditional equities and bonds, but it's blending equities, bonds, some specialist areas of the credit market that I talked about, and just broadly alternative assets. But again, really emphasizing that alternatives is more kind of different blocks of alternatives rather than one. And it's absolutely no lie that I put these slides together a while ago, and you can tell I've been doing it for time. So I think I put this together in the World Cup when I said you could go from, the Euros, when you go from 60-40 to the 4-4-2 formation of a multi-asset portfolio today. And for us, that's important. You know, when people look at our balanced funds, sometimes people say it doesn't look like you have much equities, but that's because we tend to have much more in these higher, like slightly higher volatility areas of the credit market that we think are actually really interesting ways to take that risk. And rather than just purely relying on traditional bonds to diversify portfolios, we have much larger allocations to areas like alternatives. What that means in portfolios is that when you look at a balanced snapshot, this is from our AAP balance fund, so kind of a largest fund individually in many ways. And this isn't to push the fund, it's basically just to indicatively say what that looks like when you bring it together. You can see the material alternatives allocation on the right hand side there. You can see in the government bond space very low allocations indeed, 5%, and the majority are in global high yield there. CoCo and AT1s are essentially a way of saying they're the bank debt we were talking about before, and that Angel Oak multi-strategy income is essentially the RMBS position, the US mortgages position that I talked about. But overall, it's focus on areas like strategic credit. We have large allocation to areas like EM debt and material material alternatives allocation. This is the sort of portfolio we think is better positioned to deal with the world we find ourselves in today. And from a team perspective, that's kind of how we set ourselves up in terms of specialists in each of these areas. And multi-asset selection is about much more than just traditional equities and traditional bonds today. And we have people covering and specialists in each of the areas to cover, alternatives is a huge part of our resource allocation. Probably of those 20 people, 3-4 of them focused on alternatives, and another 3-4 on specialist areas of the credit market. But we started off by talking about the 60-40 portfolio. Is the 60-40 portfolio dead? We said there's this world of lower returns that we find ourselves in. And then we said, well, if you think about the different ways that you can construct multi-asset portfolios, be it strategic asset allocation, tactical asset allocation, or instrument selection, you have different levers that you can pull in many ways. We as a multi-asset house provider have funds and model portfolios that are pulling each of those blocks. For some, the strategic asset allocation and a focus on low cost will be enough. Certainly, a focus on cost is one way to deal with that low return environment. But we think going a step further in terms of adding the alternative allocation, adding some of those tactical themes, or indeed all the way, if there is ever a time for active management, you've got to say that the current environment we find ourselves in is surely one where this is the opportunity for people to cut their soul. The easy money, the easy returns, the concentrated market, the tide of that market seems to be turning. And that's certainly what we've seen in the year-to-date period. But that low return environment, we think, actually can be a good story for advisors. Why? Because their alternative of holding money in cash in this low in this low interest rate but high inflation environment is so poor. But because those traditional asset classes return, we face a couple of choices. You can either accept those lower returns, or you can start to tweak the portfolio in some of the ways that we've talked about today. And we think alternatives are a really big part of how those portfolios can be tweaked. And hopefully we've given an idea, not just of the philosophy of how we think about that, but of one or two specific examples, especially when we talk about the merger arbitrage strategy, of how we can deliver that. And our range of portfolios is built around each of those levers of strategic, tactical, and selection. And so hopefully through that discussion, we've jumped through the hoops of those learning outcome statements. There is a positive message about low returns, because the alternatives and one of the drivers of those returns, low bond yields, low cash rates, is the alternative for investors. So do you want a lower multi-asset portfolio return, or do you want something that's literally going backwards at a pace of knots? There are methods that they can use to fight against those returns. Advisors can use, investors can use, and alternatives are a big part of them. We've given a deep dive on probably the philosophy on what we think people should focus on, and probably the philosophy on why some of the historical examples have gone wrong, being very concentrated in single strategies that were very black box and didn't keep their eye on liquidity. And with that, as probably was expected, I overran, but not by much actually. Five minutes over.
No, that's great, Matt. No, thank you very much. It's absolutely superb. And yeah, some really interesting areas to cover there. I've got a couple of questions that I'm going to ask you on some of what you've been through, if that's okay. And also, I'd like to invite anyone on the webinar to, if there are any questions now for Matt, please put them on the chat function. Of course, as always, we can cover any areas afterwards as well. So really interested in M&A activity, and the fact you said that that it's the highest last year for decades, but also the expectation that it's going to be very active in sort of post-COVID. So can you tell us a bit more about that? And I guess also you mentioned about the specialisms that you have in the team there. So what sort of things would you be looking for amongst the team when sort of considering that for the funds?
Yeah, so why will merger activity be high, or why do we think it will be high? It's essentially because partly just because money is so cheap at the moment. So if you're a corporate and you're looking to grow your business through time, the hurdle rate you have to get over for an investment to make sense is relatively low. Look, if interest rates and lending practices were super tight, and let's say a company had to pay 8% on a loan to be able to, take that loan out, issue some debt to go and buy a company, that company would have to generate growth in excess of that 8% for that deal to make sense. But clearly we know that credit is much cheaper than that level for many of the largest corporates in the world. Not just that, but they've been building up those cash reserves on balance sheets for a long time. There's always the classic story that, Google, Meta, all of these tech companies are sitting on literally so much cash, they don't know what to do with it. So that creates a backdrop where merger activity is likely to continue. But what's quite interesting actually, currently in merger land, is that that spread that we were talking about before, which essentially you can think of that as the risk that the market is putting on that merger not happen. Because if that merger is 100% going to happen, the price should go all the way to what's being agreed the day before. If it's something that's got a really complex regulatory angle to it, and it's quite likely it might not go through, you might end up with a much bigger spread. But the baseline return that you get for investing in merger transactions at the moment is in some cases in close to double-digit returns on average. So partly there's this big flow of new deals to the market because credit's cheap, but then at the same time, the base level of return that's available is quite elevated. So that's why it looks so interesting to us. In terms of the specialisms and kind of what we look at, what we try to do across the team is bring a variety of perspectives. People talk, diversity is like a big kind of drive in everything, but the idea of cognitive diversity is for us the most important dimension to that diversity. So for example, in the team we've got people that are linguists, we've got quants like me and the team that I work with who are essentially developers, programmers for a large part of our job. We've got historians, we've got economists. Actually, economists are, I think it's probably the fewest people that we have in the team are straight out and out economists. And so what we're trying to do in those different groups is bring those different perspectives. And when we bring those things together, we think we get really interesting investment opportunities. And that helps us to think outside the box in some of those areas like RMBS I talked about before, and in areas like bank debt, for instance. And one of the things I'd say there is that, the ESG drive in the industry, we have ESG products that are out there. But what I think that's almost done is encapsulated for us just a different angle of the way to think about things. So the thing I would say is, yes, we have sustainably focused products for those that want it. What I think that is an example of, and something that we've resourced in the last couple of years, is just giving us different perspectives on the other investment opportunities that we're looking at as well. So it's almost like an interesting source of idea generation that shouldn't just be constrained to ESG focused portfolios. So that diversity of thought is, for example, in all portfolios, not just our sustainable mandates, we have an asset that's linked to an equity manager that's linked to climate change solutions. Why? Because we just think that's a really interesting investment opportunity that comes from people taking that ESG mindset, which is nothing to do with jumping through an ESG hoop. It's about, we think there is a return generating opportunity in excess of the broader market for access in there. So that's where we're coming from with the team. It's about different people thinking in different ways about different things, and you bring those together and you get a genuinely diverse multi-asset portfolio rather than something that's just blending FTSE 100 stocks and global government bonds.
Brilliant. And the example you gave about the US mortgage market, and you mentioned about sort of legacy markets, and obviously the fact there's been incredible property price increases for the last 15 years. Have you had any, and you also mentioned Big Short, which is superb film for anyone else. Have you had any reticence about kind of getting back into that area because of the issues 15 years ago?
No, because I think the market has matured a lot since then. You know, if you, quite frankly, the mortgages that are around today that you can invest in are the ones that survived, right? So on one hand, you've already cherry picked like the cream of the crop that was there before. And that was really an opportunity that we were interested in, and we had some positions in portfolios pre-COVID, but post the COVID-induced sell-off, you had this big blowout, and so the return opportunity of investing in that was, we felt, much better rewarded than the risk of broader credit markets. And so, for example, investing in something, you know, never trust ratings in, you know, in RMBS markets, but let's just say equivalent investment grade ratings in the normal credit market and the RMBS market, you might get a yield pickup of like 2-3%. What we're not talking about is really high risk, like structured credit structures where we're talking about high double digit, like teen type returns. This is essentially like a 3-4% return opportunity. And so it's focused on delivering those sort of returns that credit investments used to offer portfolios, not, you know, swinging the bat or the golf club to take undue risk, but taking that in an area that we think is very well rewarded. So they're the mortgages that survived. They have all the tailwinds of what's happened in the last 15 years, i.e. paying down mortgages and the house prices rising more broadly, but it's very much focused on a return opportunity that's in the 3-4% range, so at the lower end of the risk spectrum.
Excellent. And I loved your analogy about moving from the 60-40 to the 40-40-20. So kind of moving from the Mourinho to, I was going to say Eddie Howe, but I might get shot down if I say that. But in terms of the opportunities, so, you know, there's been the beginning of the year where you get the usual spike in the FTSE return. Hasn't necessarily come through in terms of some of the fund performances as a whole, which has been a bit tough for advisors, and certainly having to go out and communicate with clients when portfolios are down. And obviously the reasons we've gone through the alternatives today is kind of counter that as well. But I asked the last speakers around inflation. What's your views sort of on inflation, short and medium term?
So I think on the short term, inflation is going to be higher, like no doubt, like absolutely no doubt. And the camp of people that were saying, you know, transitory, blah, 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 like narrow inflation is just gone, right? Inflation is pretty broad-based, it's pretty set in. People that are business owners or people that, you know, have tried to do any hiring at the moment or recently will know that the labour markets are quite tight, right? And that's a subject of, like, a result of many things, but that is at the end of the day inflationary. And so it's gone a long way, the inflation story the last few years, from being all about used car sales to something that is like much more broad-based. And it's not just about supply chains, it's about the labour market too. And all things equal, that is going to lead to a persistently high level of inflation in the short term. And by the short term, I mean for the first half of this year. Look, we're hitting levels not seen in decades. So is inflation going to stay at 6-7% a year? Like, no, basically. But that's most likely to start setting materially lower than that towards the end of the year in our view. And over the longer term, we think inflation is going to essentially be higher than where it's been over the last decade, but not to where it was pre-global financial crisis. So by that, I think it's reasonable to think that inflation should settle globally, let's say in the UK, around the 2.5% level to 3% level. So that's a pretty straight answer to the question. Expect inflation to be high, like currently sort of print levels for the next few months, certainly. Towards the end of the year, expect it to start falling, but settle longer term around 2.5-3% a year is our view. Now, what does that mean for investment portfolios, though? Well, one of the themes in our core portfolios is that we've been significantly underweight bonds and owning alternatives instead. So, you know, it depends on the portfolio, but like in our model portfolios, let's say the alternative portfolios is up 2-3% year to date, whereas bonds are down 3-4%. And one of the reasons investment portfolios may look in negative territory over that year-to-date period is because they're very likely to hold some duration, even if you're very underweight duration, and that has been a headwind. But also, globally, equity markets have performed much poorer than the UK alone. Because one of the things that's been driving inflation higher is commodities, and that's helped the UK equity market generally. So over the long run, it absolutely makes sense to be globally diversified in your equity allocation. But just owning UK equities is not a good idea. But over the short run, when people just look bluntly at the FTSE, they'd see a market that's up, 5-6% probably year to date. Whereas if you look at global equities are down around 3-4% year to date. So that's the story, and that's the divergence there. Global diversification continues to make sense for all the good reasons that we can sell the freelance diversification. But over the very short term, that may optically throw clients off if they're looking just at the UK equity return. But we think it's just another proof point that people need to be looking a bit more broadly than the assets that have done well historically. Certainly, the portfolios that would have been down the most year to date were the ones that were heavily invested in areas like tech, were heavily focused in areas like the US equity market, and potentially heavily focused in government bonds, which, yes, have done well over the last 10 years. But hopefully in all the slides today, we've given some good reasons why we think starting to diversify part of those allocations away into a portfolio that's got some alternative type assets, not just in alternative, but in credit and a more globally diversified equity content makes sense to us from here.
Yeah, absolutely. And again, obviously the question I kind of pitched you was a very sort of short-termism, so to speak, but absolutely this kind of always taking that longer-term view and links to everything you said. There's some really good material that you went through earlier, particularly when you talked about £100,000 in sort of deposit and what you would need to achieve to even reach inflation. We will cascade your contact details to everyone on the call today as well to get in touch with you guys, if that's okay, just in terms of kind of reaching out to you around material and working with you guys as well. Yeah, no, absolutely. I mean, like you said, this chart, this is I always say if I had a top three chart podium, like this would be close to the top. Where is it? And because this is this slide here. This is what's facing investors at the moment. If investors are concerned about inflation and they're concerned about looking at their investment portfolios and seeing some short-term volatility in their portfolios, we need to remind them that the only way that they can guarantee they're going to lose money over the short term is by sticking it all in cash, right? And if they did that over the last 10 years, they would be sitting on such a huge loss. It would be unbelievable. You always get these questions of like, when's the right time to invest? Markets have been going up a little bit recently. What this reminds us is that the decision not to invest is a decision to lose money. And so for me, expected returns can come down. We think we've got some really strong stories to tell investors about how we can do different things with their portfolios to try and combat those returns coming down. But let's be under no illusion. One of the key reasons expected returns are coming down is because bond yields are lower, which means interest rates on banks are lower, which means their alternative is that much more unattractive. So 4%, 4.5%, where we started off that return for balanced portfolio, some may be disappointed in that, but I think that is a really good option compared to this chart here. Brilliant. That's great. That brings it all very together nicely, Matt. So thank you so much for your time today. I really appreciate it. And so we're now going to have another break up until 12:10 when the guys from Tilney Smith and Williamson will be presenting. So thank you, Matt, and then we'll catch up everyone very soon. Thank you very much. Thank you very much indeed. Okay, so good afternoon, everybody, and thank you very much indeed for coming back for our third and final session. So it's going to give me great pleasure to introduce Daniel Casali, who is the Chief Investment Strategist at Smith, Williamson and Tilney. I should say Tilney, Smith and Williamson, do apologise. So Daniel, over to you.
Yeah, thanks there, Paul. So I'm Daniel Casali. I'm the Chief Investment Strategist at Tilney, Smith and Williamson. Just a quick background about myself. Been covering strategy now for 28 years. And I joined Smith Williamson in September of 2017. Right, this presentation today, what I'm going to be talking about is one of the key themes that's going to be happening going forward, and that is looking at a rotation theme, why we think UK equities will benefit from market rotation. And I think that the way to capture this is really in this photograph where we have our Prime Minister there trying to battle with the elements, which is the volatility that we're currently seeing in market. And the second thing is about the positioning in portfolios, and that's where one looks quite uncomfortable where he's sitting. And by positioning, I mean that we should be thinking about a rotation from the tech sector into much more of the old style economy, which includes sort of energy and materials. So in this presentation, what I'm going to do is just look at the headwinds and tailwinds that we see at the moment. And I'll just move on to the next slide. Here we see the headwinds that we're seeing that's hitting the markets. It's really talking about the removal of easy monetary policy from the Federal Reserve and from other central banks. That's left some of the investors a little bit unnerved about how quickly interest rates will be raised. We also see lapse in fiscal drag on growth. So all the boost that we saw in growth in 2020 and 2021 will be gradually be reversed. We can see that there's lots of higher inflation coming through. The question here is, do we have some sort of demand destruction where prices rise too much, they become unaffordable? COVID is still a lingering risk out there and a threat of lockdowns, but we think that given that we are now moving to a living with COVID, particularly in the UK, we think going down politically to more lockdowns is going to be very, very difficult to do. And another headwind is that with the higher inflation, it's leading to a greater risk of an equity bear market. And some of our proprietary indicators are warning about that one. It's flashing amber at the moment because inflation's accelerated, but it's not necessarily enough to offset the tailwinds, which is why we remain positive about equities going forward. And the key point there is we're still roughly in about the mid-cycle of this business cycle, and generally that comes along with positive absolute returns for equities. We still have solid household purchasing power. I know inflation has accelerated, but more people are moving into jobs, and we have seen a huge surge in wealth. Just to put that in perspective, if you went to the US and looked at the depths of the recession in the first quarter of 2020, net household wealth, so that looks at your assets, financial and also your property assets, less your mortgage, that actually fell $6.3 trillion in the first quarter of 2020. But if you want to look forward, we can see that since then, net household assets have risen by 31 trillion. So there is a big boost to this household purchasing power. We also have restocking that we think is going to come through to lift the manufacturing sector. There is a shortage of goods at the moment. We also see that the macro backdrop is actually quite conducive for company earnings. We can see, believe it or not, that profit margins have never been higher. And that's simply because listed companies have been able to raise their prices and we've been paying them. Also, we have quite a strong economic backdrop. The growth last year in the UK was up 7.5%. That was actually the strongest growth rate that we saw since the war. Of course, it came after a collapse in 2020. But looking forward, we're still looking at growth of about 4%, which is still quite good for equities. So how's all of this translated into the equity markets so far this year? And what we can see is this chart here. It looks at the performance year to date in sterling terms, including dividends. And we can see that the overall stock market, all country world, is down 4.6%. That's been really led by the US. That's down 6.2%. But if you exclude the US, the all country world ex-US is down only 2%. If you went back to March 2020, the overall market was down just about 13% and 11% for the US. So it's a lot less worse than what we saw back in the pandemic of March 2020. But the standout there is really the UK. That's actually up 3.8% so far year to date. Europe has done a little bit worse because of the concerns maybe about Ukraine. But what we've also seen within that is a difference in the style. So we're now seeing that the value part of the market, which looks at things like energy, materials and financials and also industrials, has done a lot better than the growth part of the market, which is normally the tech-related industries. We can also see that the mega caps, so this is the Microsoft, the Apple, Google, Amazon, Teslas, and also Meta Platforms, which is also Facebook, they've done a lot worse. They've been deteriorating because of this concern about inflation and higher interest rates. But what we can also see is in this environment of higher interest rates, we can see that all the bond markets have done poorly. And that's because higher interest rates means that their prices go down as yields go up. So generally, if we're looking at how markets have been performing so far year to date, the big standout winner is really about the UK. Overall equity market is down slightly, 2%, but it's really the US and the mega caps that have been the underperformers so far year to date. Bonds have been a big drag on portfolio performances. So why do we like the UK? And this is a story we've been going at for a while. Well, simply, it's really by default. UK equities have benefited from this market rotation. As investors start to move away from some of the growth part of the market, they've moved to areas where they're cheap, which is the UK, but also because the UK is quite a value-driven market. Here's a chart looking at the long-term performance we have of the UK market. It's been a significant underperformer since around 2013, and it's only recently that it started to outperform. The key question is whether that lasts or not. We think there are some elements to suggest that UK equities can actually do a little bit better going forward. And I think the real reason for that is simply they're cheap. This chart here looks at a bunch of valuation metrics to value the UK equity market. Look at it relative to the rest of the world, excluding the UK. And it looks at things like the price to earnings ratio, the price to book ratio, and the price to dividends. So the higher it becomes, the more expensive the market is. And what we can see is since the referendum, the Brexit referendum in 2016, the UK market became a really unloved market. We saw that the valuations continue to come down. In other words, it started to become derated. It wasn't just the referendum. As we know, there was other elements here, the risk of Corbynism, Theresa May's disastrous early election, which led to political paralysis. And also the UK was worse affected by the pandemic. What we did see is really a trough in the market. And that came with the Pfizer vaccine announcement. That was in November 2020. And what we are starting to see now is that the valuation of this market is now starting to come back to levels, pre-pandemic levels. We have seen that the GDP, for example, in the UK is now back to pre-pandemic levels, but it's not fully reflected, we think, in the valuation. We think there's a long way to go for this valuation to go back to a sort of average that we have had in the past. But why do we also like the UK? Well, we think that the risk of lockdowns are lower in the UK than outside of it. There are still some parts of the world, Canada, for example, there's further lockdowns in Hong Kong, that still have that lingering effect from COVID. Looking at it exclusively through investors' lens, when we look at the UK, we can see that there's less risk really of the UK being locked down. And one of the key reasons for that is the politics. We now see that the Tories are about 10 percentage points behind Labour, and any more COVID restrictions are likely to be unpopular. So with the May election, local elections coming up, obviously Boris has been advancing a living with COVID agenda, and other countries like Sweden, Denmark are following suit. But because there's less risk of a lockdown coming in the UK, investors may look at the UK differently. Also, if you look at the amount of booster shots that we've had, we're up there with the Italians in terms of the amount of booster shots. So it also means there's less risk, perhaps, of another variant becoming more severe and having a burden or burden on the healthcare service. But there's a third argument to look at the UK, and that relates around the really by default why the UK is doing better. It's really about the structure of the equity market. This table here looks at the weights by the major 11 sectors. What we find in that red row right at the bottom, that the UK is the highest share out of all the other developed markets in terms of old style sectors. We would define old style sectors as energy, materials, financials, and industrials. So given that we are starting to see rising cost of commodities, which is boosting the earnings and margins of the big energy companies listed in the UK, but also a higher cost of capital, which means rising interest rates, benefiting financials because they can lend more and receive more for it. We see that the UK has actually been benefiting from that. If you want to make a comparison, the US, it has only about 25% of its market is in old style sectors. It has much more of its share in the IT related and some of the mega caps, which is in consumer discretionary. So there's a big difference between how the UK is structured in terms of its market relative to some of the old, one of the other markets like the US, which is much more tech centric. Why do we think that the old style sectors are likely to do better? well, it's really related to this chart. This chart here shows you the trailing earnings per share, so company earnings, relative to the world ex-UK. And what we can see, looking at that red line, it's still got some way to go to catch up with the rise that we're seeing in commodity prices. The commodity prices will lead to the higher relative earnings in the UK relative to the rest of the world. What we are seeing at the moment is events developing in the Ukraine. But even if we take away the Ukraine, we can still see that there are other reasons why commodity prices are remaining high. One of those is due to inventories, which we'll talk about in a second. But also it looks at the structure of, say, the gas market. If you look in Europe, for example, there has been significant reforms where Europe has moved away from linking gas prices to long-term contracts to looking at linking gas prices to current supply and demand. And given that we have the climate agenda, which is reducing fossil fuel investment, low historical inventories of gas, and also this move towards competing areas for gas, like Europe is competing with Asia, this probably means that energy prices are likely to remain elevated for some time to come, even if we have a de-escalation in events in the Ukraine. Well, let's go look at some of the risks for this thesis. The first one really revolves around bond yields. This chart here looks at the UK performance relative to non-UK equities, and that's the red line to the left-hand side, and the line on the blue line on the right-hand side looks at something called the 30-year gilt yield. So that's how much the government borrows at the very long end of the yield curve. And what we can see is there's a clear relationship here. As yields go up, it generally benefits the UK as against other markets. And there's a simple reason for that, because we have, as I showed you one of the earlier slides, there's a large proportion of the equity market with the financial sector. So as the bond yields go up, not only is it a reflection of better growth, but it also means that banks can charge more in terms of the spread between how much they charge customers and their borrowing costs. So it means a widening net interest margin, if you like, and that should boost the financial sector. Of course, conversely, if yields were to decline very, very sharply from a very sharp correction in growth, for example, that could happen if central banks become much more aggressive in tightening monetary policy, then that would make it difficult for UK equities to outperform. A second risk, which we get a lot, is really about the rising cost of living. We have seen inflation at multi-decade highs in the UK. Petrol prices the highest ever. We've got national insurance rising from April, and also Ofgem is going to raise their energy cap by 54% also in April. So a lot of that tells us there's going to be a squeeze on household incomes, and that will be a drag on overall growth. In this chart here, I look at something called real labour income, and that looks not just at what the real wages are, but also looking at employment. If you remember, I talked about employment has been quite strong, and it's now above pre-pandemic levels. So if you combine the two things together, so employment and real wages, it does show you that consumption is actually moving back to catch up with that level of income growth. What we can see from Bloomberg there, looking at the forecast for household consumption, we can see in 2022, household consumption is still expected to grow at a fairly hefty rate of about 6.1%. The risk really comes in 2023, where growth is likely to slow. So all of the post-COVID recovery and the cost of that borrowing, the government borrowing, will start to bite next year, but not this year. And that's why we think that this household purchasing power is still likely to remain fairly strong at the moment. And just a little bit about those commodities that I was talking about. While the press will talk about the events in Ukraine driving up energy prices, and to some degree there is certainly an element of that, but there's another element, and that's because this chart here looks at the OECD commercial oil inventories, all the big major economies, and it's inverted on the left-hand side. So as this starts to rise, it's telling you that the oil inventories are being drawn down. That's simply because we're now seeing demand recovering from the pandemic, and also the fact that suppliers are not keeping up with demand. One of this is due to the climate agenda, perhaps. And what we are seeing is that there's a very strong correlation between that, the OECD oil inventories, and the Brent crude oil price. We can see that it's now currently up to $93, but there is potential for this to continue to rise as those oil inventories are drawn down. And that leads into why the UK is likely to perform, because as commodity prices continue to rise, it tells us that the company earnings in listed UK areas like energy are likely to do better, also for materials. So bringing this to a conclusion, we make the first couple of points. The first one is UK equities are still heavily discounted. They're very, very cheap. And all that really dates back to the referendum that we had in 2016. They're still nowhere near what they were back at that level. The second thing is the UK is now advancing at living with COVID theme. That essentially means that any risk of lockdowns is a lot lower in the UK than out of it. It means that any sort of discount is likely to be reduced, and that should be a benefit for UK equities. Third thing is looking at how the UK market is structured. It's really structured to the old style sectors like energy, materials and industrials, and also the financials, which will obviously includes the banks. It's done quite well out of this rotation out of the tech sector. So in a strange sort of way, it's actually been less risky. But the risks are related to those bond yields. So long as bond yields continue to go up to reflect stronger economic growth and a degree of inflation, UK is likely to be an outperformer out of its other markets. The second thing is talking about consumer purchasing power. Yes, there are certainly some headwinds coming along to hit the consumer. But remember, if we look at the real household purchasing power, it's still relatively strong. And this takes into account inflation. And the third thing would be if there's a slump in global growth, this could happen if Putin does roll his tanks into the Ukraine, or we have very aggressive central banks cutting back on their accommodative policy. If that was to lead to a slump in global growth or another outbreak of COVID and lockdowns, then that would drive down commodity prices and the UK would probably do worse. But for the moment, we think there are enough arguments here to suggest that perhaps the UK is going to be one of the key beneficiaries from this rotation from some of the tech sector and moving to this sort of old style sectors, which we think the UK will benefit from. So I think I'll leave it there and see if there's any questions or pass on.
Daniel, are you going to be staying on for James's session?
Yes.
Okay, brilliant. So what we'll do is we'll get James to do his piece, if that's okay, and then we'll ask you both some questions at the end. But thank you very much, Ian. That's really interesting and
sure.
Very much appreciated. So James, how you doing? Oh, I think you're on mute, James.
Sorry, that's just a Zoom error, isn't it?
No problem at all. How's things?
Very well, thank you, and hello to everyone, and thank you for inviting me. I'll just share my screen, if that's possible. Bear with me. There we go. I stole, we'll go back on the screen. So thank you. So this presentation is focusing on the issue of crypto assets. It doesn't seem to be many days in the media that some sort of news headline features something to do with crypto assets or non-fungible tokens. So the basis of this presentation is going to focus on the sort of general background to the sort of evolution of money. We'll go into talking a little bit about background of cryptocurrencies, how they operate, some of the key issues, and from a practitioner perspective, some of the practical issues that well, hopefully I'll cover will help you deal with clients who may come across with issues perhaps regarding some things as capital gains and income tax concerns. So first of all, I think we're all aware of Bitcoin. We hear a lot about it. We hear about the tremendous returns that have been achieved historically. This chart is from CoinDesk, and this chart goes back to 2014. But essentially, from that date, from recent times, Bitcoin is up around 60,000%. That's an immense amount of rise. Yes. Bitcoin was the first issued cryptocurrency back in 2009. It hasn't really been until the last 5 years that it's gained this tremendous amount of traction and a news flow that is attached to it and other currencies. But yes, perhaps the reason why it's had so many headlines as of the other currencies is its FOMO. People heard or know, or by hearsay, have heard that people have made a tremendous amount of money. It is the whole FOMO issue, and perhaps it's really easy money. So here in this slide here, we show you 4 tiles. On the top left-hand side, you show the Winklevoss brothers of social network fame. These 2 guys were at Harvard with Mark Zuckerberg. They originally employed Mark Zuckerberg to produce something like Facebook. I think we know the story from there on inwards. But these 2 brothers were reported to be Bitcoin billionaires. The top right-hand side, you'll see is an industrialized crypto farm. So these are these farms that burn lots of energy that use their hard drives to ultimately compute the blockchain algorithms that power pretty much all the proof of work process. We'll come to that later on in the presentation. The bottom left-hand slide, you see Elon Musk. He's been often tweeting about certain cryptocurrencies, including Dogecoin or Dogecoin and Bitcoin. Tesla last year was reported to be able to accept Bitcoin currency at one time for its cars. And then on the bottom right hand, we have a farmer in Wales. Behind him sits what we call an anaerobic digester. Essentially uses his dairy farm cow poo to generate cheap or free electricity to power his crypto farm, which he farms currently Ethereum. He actually earns more from farming cryptocurrencies than he does from his dairy farm. The economics of it all. But in order to understand where we are today with cryptocurrencies, we need to first take a look at the evolution of money. Now, back in the Stone Age, transactions obviously were being largely completed on bartering. You exchange one item for another. We can still do that today in some cases. Then obviously mankind evolved. We were swapping objects in the South Pacific. Exotic seashells were used. Then we come into the Middle Ages, paper money and coins were used. Then more in sort of Georgian times, we began to use gold as a method of payment, or at least in the form of coins. Then obviously last century, we were started to use credit cards and debit cards. Then over the last 30 years, we're starting to use phones and other devices to transact money transfers. And then lastly, in this evolution timescale, cryptocurrencies are the natural evolution of this process. However, if you go back to the gold standard, I'm not going to talk too long about this area because it's a separate presentation itself if we want to talk about it. But ultimately, the last westernized country to give up the gold standard was the US in 1973. The dollar was originally tethered to a certain value in gold, and it had to give it up after the debts incurred by the Vietnam War and other social reforms. In the UK, we ducked out in 1931, the depths of the Great Depression. But essentially, each piece of currency was exchanged for a certain amount of gold, and that was the standard back then. However, because no government could continue to borrow indefinitely and match just for a certain amount of gold, it had to leave the gold standard. You're forced out of it. And now we're operating in the world today what we call fiat money. So fiat money is what we all know, whether it's dollars, sterling, or euros. Essentially, fiat money is backed by an issuing authority, usually a central bank, but ultimately by the government of that central bank. It is ultimately not backed by any physical commodity such as gold. It's just backed by the stability of the issuing authority. So we've got to be comfortable with ultimately the country's finances, and will ultimately dictate how well a fiat currency will perform. So fiat money is ultimately created through central bank issuing the money. It will influence and potentially manipulate the money supply through quantitative easing, which we know all about since the global financial crisis. But essentially, quantitative easing is a way of electronically printing money, increasing monetary supply into the financial system. They can also control that through raising or lowering interest rates, and obviously buying and selling your own government debt. And particularly with the US Federal Reserve in 2020 up to 2021, they also started physically printing US dollars by a significant amount. Actually, 40% of all US dollars ever printed were produced in that 12-month period up to April 2021. So again, fiat currencies can be manipulated. The supply of a fiat currency can exponentially increase. And that's what we've seen since the global financial crisis, and exacerbated by the COVID pandemic time period as well. So what do cryptocurrencies offer? They offer ultimately a separation between of money and state. It's completely decentralized. It's not something that can be manipulated by the issuing authority. And below here, you have a number of sort of icons. Some of you may recognize this, but such things as obviously Bitcoin. We'll see the icons there. Ripple's another cryptocurrency. But ultimately, today, there are over 1,000 different exchange tokens available to potentially buy or sell. In terms of the crypto assets themselves, HMRC have a definition. Different banks or entities will define it, but ultimately HMRC have stated 3 types of tokens. Exchange tokens is the type of cryptocurrencies that we recognize more so. We can also get utility tokens and security tokens. Utility tokens provide potential access for goods or services, whereas security tokens will actually give you some sort of legal ownership or perhaps a debt of a business or profit or shares of a business. The only real tax guidance that's come from HMRC is in the realms of exchange tokens, particularly in the form of capital gains and income tax. So given the background to cryptocurrency, the ideology was initially issued in what we call the Cyberpunks Manifesto, which was issued in March 1993. Essentially, you'll see the statement there, but they kind of provided the ideology of the concept of peer-to-peer cashless system, which is what we saw in a seminal paper in 2008, which was on Bitcoin, issued by an entity called Satoshi Nakamoto in 2008. Satoshi Nakamoto is not actually an individual. We believe it's actually a group of individuals who provided this white paper. It was the prelude to actually issuing of Bitcoin, which was in 2009, a year later. So again, properties of cryptocurrency, these are the key criteria what make potential cryptocurrencies attractive. So unlike with typical exchanges in terms of financial markets, the concept is that cryptocurrencies are actually an open public network. Effectively, anyone can be a part in, own or sell exchange cryptocurrencies. It's not so open when you're buying shares or bonds in financial markets. You have to have accounts, you have to subscribe, you have to deal through an entity. It's permissionless, so there's no middleman, no bank, no government, no company. It's freedom to transact whoever you want. This is pure what we call DeFi finance, complete disintermediation of the middleman. They've got to be immutable and transparent. So what we mean by that is that these cryptocurrencies are backed up by what we call blockchain technology. So they're secured in blockchains that cannot be altered. However, these blockchains can actually be publicly viewed, and each transactions can be viewed within each blockchain. And ultimately, it's fully transparent on that basis. It's completely decentralized. So blockchain, the way it works over computer servers. So the more servers there are, the more different nodes, the greater the computing power. Ultimately, you're not relying on one particular point of failure. It's devised over the whole network and system. That makes it very attractive. Also, cryptocurrencies are generally issued with a fixed amount of supply in the form of Bitcoin. There's a maximum amount of supply can only be issued to 21 million. To date, there's only about 8.5 million Bitcoins that have been issued to date. The last available Bitcoin will be issued in 2140, based on the construct of the algorithm for Bitcoin currency. However, this is a very important slide. So we call this the blockchain trilemma. Now, there's three issues here: scalability, decentralization, and security. In terms of construction of a cryptocurrency and blockchain, there's ultimately a form of compromise. In a traditional exchange system, you have one exchange with securities listed on there. You have full scalability, you are centralized, and you have full security. However, the properties of blockchain is that you've got to balance the interest between scalability, decentralization, and security. To give you an understanding, blockchain will only compute at the moment for Bitcoin about 4.6 transactions a second, whereas Visa, the world's largest payment system, can do about 1,700 transactions per second. Visa claim they can make 150 million transactions a day typically. Again, there is a bottleneck in terms of technology and the rate of transactions that can be applied. So it's unlikely that cryptocurrencies at this stage of development will be able to use to buy your groceries or pay your utility bills. The transaction time would be just too slow if everyone wants to take it up en masse. This is a really important area. The consensus algorithm, otherwise known as distributed ledger technology, or aka we know as blockchain, the two main forms, proof of work and proof of stake. Now, proof of work is what kind of backs up the Bitcoin currency and traditional many of the earlier cryptocurrencies that have been issued. Proof of stake is what's generally used now on the cryptocurrencies that have been issued more of late. Proof of work has had a bit of a poor reputation of late because the way the algorithm is constructed. So again, you heard of the crypto mines or crypto farms in China last year that were shut down because of the high energy usage. Ultimately, in China, a lot of the energy comes from coal-fired power stations. Obviously, China is not going to meet its COP26 levels if it continues to have a growing crypto farm industry. So a lot of those crypto farmers moved to different countries, perhaps into Russia. Some have moved into the States. Wherever there's a cheap energy source, ultimately you get a greater level of profit. But the way that blockchain works is that over a decentralized network, each one of these servers will actually help compute a part of the blockchain transaction and earn a fee on that basis. It's very energy intensive. The proof of stake methodology relies on the owners of the different cryptocurrencies to put at stake to the network a certain level of their ownership, and it provides part of the computing power to provide the blockchain transaction. It's less energy intensive because it uses less servers to do so. Security is a big area. We have something called hot wallets and cold wallets. Hot wallets are generally wallets that have openly connected to the internet. So typically would be on your smartphone, tablet, or general computing device. The issue about them is they're easy to use and store your crypto on. However, they are more vulnerable to computer hacking. There have been many instances where these hot wallets have been raided. They may be issued by the exchange, perhaps that you'd utilize to transact on, or via on the apps you would normally download. Then we have cold wallets. Cold wallets are an offline wallet. They can be effectively storing your holding on a separate hardware device, a separate computer, or like a USB stick that you can plug in, plug out, and ultimately they're not connected to the internet. There was a case actually within our professional services division when we were auditing a particular client. The client had discovered that actually their holding in a hot wallet of Bitcoin had actually been stolen. It was a couple £100,000 worth. The reason why they're holding this position was actually when their clients wanted to transact with this currency for the payment of their services. And that's not uncommon, actually, particularly in the sort of the design and creative industries, which obviously will probably follow this area much more so than other areas. Another way to secure your cryptocurrency holdings would be actually completely taking it offline altogether and actually physically writing down what we call your private keys. So for Bitcoin, the 24 keys that are effectively 24 passwords, which would technically unlock your holding in that particular cryptocurrency. You can actually even get on Amazon metal plates where you can actually stamp your code or your passwords for the 24, so you don't even lose your bit of paper. The key thing is security is a big concern, an issue with holding cryptocurrencies. Lastly, I'm going to briefly cover this area called non-fungible tokens, which we hear a lot about in the press over the last 12 months. It's been a particularly big growth area. This particular artwork is called Melania's Vision. This is Melania Trump's eyes in cobalt blue. It was a big seller in December time. You could have purchased this lovely portrait in December for 1 Solana, which is a cryptocurrency only recently heard of. And it was about $170 at the time. You'd be pleased to know that all proceeds went to charity. The key thing here is that it is a growing area, digitized artwork embedded in a blockchain, and we'll see this area continue to grow. Again, the tax authorities are very concerned again about money laundering issues, which I'll cover on in a minute. So the practical issues, well, regulation and acceptance. I mean, central banks and governments are extremely concerned, to say the least, about the speed and adoption and take-up in cryptocurrencies by investors. It's estimated that even in the UK, about 1 in 20 adults has had some sort of dabbling in cryptocurrencies, although the average sort of holding size is somewhere between £200 to £300. Obviously, some people have made tremendous profits of a much larger scale. But from a government and central bank perspective, it's the risk of loss of monetary control and ultimately ability to control the money supply. But the other real concern, particularly from a regulatory perspective, is the criminal activity that's associated with it and potentially money laundering. So it's estimated from a recent Sydney University paper that around 40% of the transactions on Bitcoin were from criminal activity, with about 25% of the users involved in criminal activities as well. So that's quite a major stat if it anywhere near correct. It's an area that is obviously concerned there. Regulation, depending on how that regulation's constructed or formed, it could create potentially outright ban of cryptocurrencies, which will obviously potentially destroy the market, or actually create distortions in the market itself. Regulation obviously could help legitimize some crypto assets, increase take-up. Central banks in some areas have been talked about considering opening up their own digital currencies. These are all rumours. Ultimately, it's about which banks or which areas of regulatory authorities will be prepared to make the first move. Early last year, the SEC in the US allowed a tracker fund for cryptocurrencies to be constructed and marketed. So we'll see how the evolution happens there. Caveat emptor, be aware, buyer beware. The FCA considers currently that crypto assets are all ultimately high risk and speculative investments. That won't come as any surprise. But currently, all these type of investments are not covered by the Financial Ombudsman Scheme or the Financial Services Compensation Scheme. So it's very much buyer beware there, and you'll be prepared to lose all your money. At the end of 2020, the FCA obviously increasingly concerned about money laundering issues for firms in the UK that were dealing or trading in crypto assets, were basically aligned to be able to register for the FCA for money laundering rule purposes. So every business in the UK, if it's legitimate, has signed up to UK money laundering rules. And there's a register actually you can go to on the FCA register to check which particular firms are currently on the register. However, it does not mean they're registered or authorised in the sense as we would understand for the industries we work in. But there are a high number of scams relating to crypto assets. It's the Wild West out there. In terms of investing in cryptocurrencies or assets, the the issue that some people have is that they have no inherent value. They're not backed by a particular asset, such as a precious metal or gold. They're not backed up by the cash flow or finances of a country. Yes, they are decentralized, but that can be seen as a positive, but also as a negative. With no central exchange, it makes ultimately price discovery harder. It ultimately increases the transaction costs when completing transactions in cryptocurrencies. Quite often the bid offer spreads are very wide and quite often in the 3% area. And a lot of the cryptocurrency assets trade on very narrow liquidity and in some cases barely traded at all. So again, you can get these fantastic performance rises, but again, traded on very thin margins, which from an investment management perspective is quite concerning. Again, price moves are generally often not determined by sentiment and speculation. And I call this the next marginal investor, which ultimately leads to more volatile swings in price, is what we have witnessed over recent times, especially with the major cryptocurrencies. Then from an advisor perspective, estate planning has big issues there. It's estimated around 3 to 4 million of Bitcoin has actually been lost, is out of the market. And it's largely suspected either it's been lost or actually lost through death. So it's very critical. If you are a major owner or seriously involved in cryptocurrencies, you need to leave some form of mechanism for your beneficiaries to pick up the information to be able to access the crypto assets. And what people forget, ultimately, crypto assets still considered to be an asset for property. So it still comes within your estate for IHT purposes. So again, maybe the use of trusts could potentially mitigate those issues. Again, there is a lot of confusion over individual investors about what taxes apply. Particularly, a lot of people think that buying and selling cryptocurrencies is kind of a form of gambling and not subject to any taxes. But yes, they are from HMRC perspective. Capital gains and income tax are applicable depending on what you're involved in. So particularly with capital gains, buying or selling between individual cryptocurrencies or or transferring in and out of a cryptocurrency to a fiat currency, that is subject to capital gains. Again, if you use or able to use your cryptocurrency to actually buy a good or a service, again, you're leaving that cryptocurrency into a service or good, again, subject to capital gains. If you're just trading between cryptocurrencies, again, you're transacting, it's subject to capital gains. Again, if you give away, it's subject to gifting rules. But ultimately, the same capital gains tax calculation methodology is the same for investing and buying into shares as well. So again, be very aware on those issues. And typically, when you do buy and sell cryptocurrency assets, it won't normally just be one transaction. It could be a dozen or 24 transactions or more that actually complete that full transaction. So you have to make sure you keep a copy of those details of your particular exchange or entity you use. Income tax concerns. It is possible to actually be subject to income tax via employment if you actually trade a cryptocurrency called cryptocurrencies as part of a living. You're effectively a trader. Effectively, your profits would be taxed as income. There are certain HMRC requirements that you'd have to meet for that. But other areas you can earn income from this form of staking in terms of proof of stake blockchain methodology. Then mining and lending and airdrops, all form of ways you earn income from cryptocurrencies, again, subject to income tax at your marginal rate of income tax. And just really lastly, just to leave you on this, is that the area of cryptocurrencies is still evolving massively. It's not going to go anywhere soon. It will evolve. I expect regulation to come to this area. I expect there to be security improvements and ultimately taxation. The HMRC are looking in this area in great detail. So it's not a way of tax evasion or form of money laundering. Thank you for your time.
Excellent. Thank you very much indeed, James. So we have had a few questions come in. So the first one is, why do the HMRC not regard crypto as a currency, but acknowledge it can be used for payments? are we assuming that's for tax reasons?
Yeah, you may have seen actually, and I should probably clarify this in the presentation. I've used the term crypto asset and cryptocurrency interchangeably. The HMRC don't recognise crypto asset or cryptocurrency as a currency as we would understand it. So they call the likes of Bitcoin and other cryptocurrencies as a crypto asset. So they're determined that actually, if you're buying and selling and making gains or losses, it is subject to their rules of capital gains and income tax.
Okay. And another question is, are there crypto trading platforms in the UK? Yes, that there are ones you can access, and this is the whole problem about being decentralized. It doesn't matter, I guess, if the FCA try to regulate the market as much as they can. Ultimately, it's on the internet to be able to access different exchanges accordingly. But again, I would say actually most of them are probably, most entities that people deal with are not necessarily UK based. There are a few entities in the UK that obviously do cryptocurrency transactions, but again, they're not regulated and they're not authorized. Okay, great stuff. Thank you very much, indeed. And this is a question from myself. Do you have any estimates to when do you think it will be recognised by HMRC and the FCA?
I suspect, I can only speculate, but the FCA, I do understand, trying to employ crypto assets, people with crypto asset knowledge, experts, but I suspect that anyone who's highly knowledgeable and able in that area probably wouldn't work for the FCA. So I suspect that it could be some time ahead of us before there's clarity on that. I think what the regulators are looking at is probably FCA is see what the US does first, yeah, and then act afterwards. No one really wants to be a first mover in this area, and I suspect that there's a lot of potential issues with being the first mover because they will see which could be the regulatory mistakes that could be incurred. I think it's probably an area that's probably impossible to properly regulate ultimately.
Okay, thank you very much indeed. And Daniel, I see you're back with us. Can you see the question that's been asked for yourself?
Yes. Yes. So the question there about does the thesis still apply to emerging markets? In short, yes. I didn't go into more detail with the emerging markets, but they too are much more on the value-centric route. But if you were to break down the emerging markets, you'd find that a lot more is in financial sector, particularly led by the Chinese banks. One reason why emerging markets and China done poorly last year, it's really down to the regulation that was introduced by the Chinese government and also the fact that they were tightening credit. But one point I would make is back in December, the Politburo, which is the 25 most senior member of the Chinese Communist Party, they moved away in their meeting to suggest that they're not going to do more regulation and they're going to do more policy easing to support growth. So that drag that we saw last year for emerging markets from the regulation and the credit tightening is less likely to happen this year, which gives us optimism that, ironically, while the West is tightening, like the Bank of England or the Federal Reserve, we can see that China is actually loosening. So yes, that thesis still applies to emerging markets, but there is this risk about regulation, which we think has been reduced. Excellent.
And really interesting point you made around the fact that the US market only constitutes 25% of what we deem to be an old style sector.
Yes.
Compared to the UK. That's probably given us a bit of food for thought. But again,
exactly. It tells you you've got much more risk. If you think that the mega caps are just going to go from strength to strength all the time, yes, they were given a huge boost from the COVID, but the market reflects that. The valuations have been moved quite highly. And if we move into this new environment, which is higher inflation and rising interest rates, there's that boost that they had previously is less likely to be a boost this time around. They're likely to suffer from higher interest rates than other markets like old style economy, markets like energy materials.
Excellent. I don't, unless there's any more questions which anyone has to put in the chat. We've had a few in there, so I'm very appreciative of those who put the questions in. So I think that is probably it for today, chaps. So thank you very much indeed. Really appreciate it. Really interesting, both elements of that. And certainly an eye-opener for us in terms of both from the crypto side, but also always good to get a bit of an economic update, but also because I think, as I mentioned in one of the previous presentations, there's been a bit of concern from clients around the start of the year and how markets have been doing. It just gives us a really good, some really interesting sound bites to take back to clients and share with them as well. So Daniel, James, thank you very much indeed. for that.
Pleasure.
Very much appreciated. So that pretty much brings us to a close today. Just a couple of bits of housekeeping for myself. Huge thank you to Alex, Matt, James and Daniel for the presentations today. All very different, but all really interesting, and certainly giving us lots of food for thought and things to take away and use with our clients. As always, we'll be coming out to you for some feedback on today's webinar, and that of course will then enable you to get your CPD certificate for today's sessions. As always, really very keen on not just feedback on today, but also on what you would like us to do to shape future sessions. But apart from that, huge thank you from me, and very much enjoy the rest of your day. Thank you.